Thank you. I don't hear anything from the index funds. Where are they? It's really feels good to get back and be doing this in person. It's been 3 years, and it's a lot better seeing actual shareholders, owners, partners, and Charlie and I are now combined. If you're around for fractions, the two of us are 190 years old, and I really think you're entitled, if you're the owner of a company, and you've got two guys, 98 and 91, running the company, you're entitled to actually see them in person. I mean, it really shouldn't be too much to ask that. I mean, for example, if we had a manager someplace that was 98, I might want to send somebody by occasionally to see whether he was cutting about paper dolls or something. We probably do things that are a lot more foolish than cutting out paper dolls, but we're having a lot of fun doing it, and we really have a lot of fun when you come visit us. Actually, we had to go back a few years. We've had a couple of managers that suffered from dementia, probably many more, but I mean, I'm just a couple known ones actually. And there was one fellow that Charlie and I really loved, and he ran a business for us. Charlie was out in California. Charlie would see him occasionally, and I didn't see him, but everything seemed fine. And then we found out that he'd really been suffering from dementia for quite a while, and he really was a wonderful friend of both of ours. But the business had done fine, so that's become our test. Really, is that for new businesses, and we try to find something that a guy with Alzheimer's can run, actually, and and you don't have as much competition for businesses like that. The guy sitting there cutting out paper dolls, and that's our man. I'd like to introduce two fellows who really work at Berkshire. On Charlie's left, Greg Abel, who runs all the operations outside. Yeah. And next to him is, I ran the insurance business for about 15 years unsuccessfully, and then fortunately, the fellow on the far left came in one day, and I've written about it, but he came in on a Saturday, and I was opening the mail, and he said that he'd be happy to run our insurance business. I said, have you ever run an insurance business? And he said, no, and as I mentioned, I said, well, I never won one either, so I'm not doing so hot, so give it a try. And he transformed Berkshire Hathaway, and Ajit Jain is here with us. What we'll do today, and I have to remind myself from time to time that the people here, of course, saw that movie and everything, but of course we're webcasting so I'll probably make some references to the movie or something that'll puzzle millions of people out there, but you'll get it. So we're going to talk for a little while about what's happened in the last quarter and bring up a few other things that you might be interested in. And we will then, whenever that's finished, we'll go on to questions, and we will take the questions until noon. We'll break for an hour. That's Midwest time for those of you who are watching in other time zones. We'll go on till noon, and we'll break for an hour. And then Charlie and I will come back, and we'll take more questions until 3:30, and then we'll convene the shareholders meeting at 3:45. We'll take a break for 15 minutes, and then we'll do the shareholders meeting. And when that's done, we'll all go our various ways. I do want to report, incidentally, that you've been doing your part in terms of the room we have adjacent to this location, where we've been yesterday for 5 hours. From noon to 5, we had 12,000 shareholders come and just spend money on everything we could think of to solve them. We brought in 11 tons of See's candy, and if we don't sell out, Charlie and I get the rest. So, but you did your part. She's sold more. They set a record yesterday for the Friday afternoon meeting, and it's pretty heartening. Yeah. Incidentally, I've got a box of See's candy here, and it's sort of interesting. On this cover, which I hope you can see, there's a picture of a woman who was born in 1854. And today, she probably gets her picture seen more often than just about any woman in America in terms of a commercial product or something of the sort. So we've got her picture up in over 200 stores, and on every box of candy. That's Mary C., born in 1854. A lot of people think this is me in drag, but that is not true. I mean, there's a certain resemblance, but it's just not. These rumors are started by our competitors. Don't pay any attention. We will. That's our schedule for the day, and what we will do. We like to give shareholders, owners, partners. We like to give everybody the same information at the same time, and preferably do it when stock markets aren't open. It seems to us that everybody ought to be on the same playing field. It's very interesting. We don't know how many shareholders we've got. They've changed the rules over time as to registered holders and getting stock certificates and all that sort of thing. So we can't keep track of it like 50 or 75 years ago, where we had an actual shareholders list. But we're told by the people who mail out our information. It's a firm in, I think, New Jersey. Let's see, Broadridge. And they pretty well do this for a very significant percentage of American corporations. So they actually mail things out for us, and they bill us for 3.5 million accounts. And I'll take their word for it. I mean, the more accounts they bill us for, we pay them by the account. So, some days I feel like I'd like to count. But that is that is a lot of people that trust us, and they rightly, in my view, overwhelmingly feel that they're our partners. And some of them will like reading the financial information they've given us, that we give you. But a great many of them just say, we've saved this money, and we trust you and Charlie. And that's a great motivator, is trust. And, take care of it. And I'm not going to learn accounting and try to read all those statements or anything of the sort. But we do believe that for those who do use the information we release, they should all get it at the same time. And we have a few institutions that, even though in the third paragraph of my letter every year, I refer to the fact that we want to have everybody get the same information, and that we don't feel that anybody's entitled to special meetings. We can't hold 3 million special meetings with our partners, but we like the fact that everybody gets the same deal, everybody gets the same information. Up this morning on the internet, we put up our 10Q for the quarter, and I'd like to take through a few comments on that, and a few other comments, and then we'll get to the questions. When we get to the questions, we will alternate between those mailed in by shareholders, which Becky Quick at CNBC and people who've helped her have sort of curated to get what they think are the most interesting questions from shareholders. They're not from CNBC itself. They are from shareholders, owners. And we'll alternate the ones from sent in versus the ones that come here. And we don't get the questions ahead of time, and we enjoy getting surprised by, I'd say, almost all questions. And we will keep doing that, like I say, with a break for lunch until 3:30 when we'll have the meeting. So I would like to start by putting up the first slide, and which is Q1. And there we have it. That's what we published this morning. And there are really no great surprises in terms of the quarter. I mean, there are always some companies that are doing very well, and there are some companies that aren't for one reason or another. And in the end, as you can see, we prefer to use something called operating earnings. Now, that is after depreciation and interest and taxes, unlike other companies that prefer to tell you anything but what they earned. But we do separate out capital gains. Now, over time, as I've said, over the next 20 years, I would expect us net to have more capital gains than not. But who knows? I hope I'll report to you in 20 years whether that's happened or not. But as you can see, we made about $7 billion in the first quarter, and that's real $7 billion. I mean, we basically have that in cash when the quarter's over. That isn't true every quarter exactly, but we are talking about $7 billion of real money in that, and those managers who the people here saw in the movie, they're the people that work with your money to accomplish what Charlie and I never thought never really planned or anything to happen, but it just sort of came about with sort of putting one foot in front of the other. Now, obviously, the last 2 years in particular, including the first quarter, there have been all kinds of unusual things happen in our various businesses. I mean, when we had the meeting 2 years ago in roughly the start of May of 2020, we didn't know what was going to happen with the pandemic. We didn't know what was going to happen with the economy, and everybody that thought they did has gotten all kinds of surprises since. But here we are in 2022, and Berkshire, like I say, had $7 billion of operating earnings, and we've got lots and lots and lots of companies. We've got 360,000 people out there that have taken your savings and go to work every day, and they have jobs. We deliver products, and you put up the money for it, and you deserve to. You took the risks, and we feel very good about how things have turned out, and we want to keep feeling good. And we have a extreme aversion to incurring any permanent loss with your funds. If I went broke, it wouldn't really make any difference. I mean, I'd keep doing what I do. I'd figure out a way to read a paper and watch a little TV and think about things and talk to Charlie. But the idea of losing permanently other people's money, people who trust us, really that's just the future I don't want to have. And as Charlie says, all I want to know is where I'll die, so I'll never go there. And that seems pretty sound. He has a way of.
It works so far.
In case you missed it, Charlie says it's worked so far, and we would die psychologically if we lost a lot of other people's money. We wouldn't take it in the first place. It'd be crazy to take people's money and lose it if you're going to feel terrible about doing it. So the one thing I can tell you about Berkshire Hathaway, I can't predict what our earnings will be, and I can't predict what the stock will do, and we don't know. We don't know what the economy will do and all of that sort of thing. But we do know that we wake up every morning and we want to be safer in terms of your eventual investment. Not whether you make the most money or anything. We do not want you to get a terrible result because you've decided to become our partner. And that's a pleasure we'll live by. Now, let's see what we have here. On Q2, it gives some indication of that because this is kind of interesting. I wrote a letter to our owners, and it was dated February 26th, and that was a Saturday, released. But I write the letter all through the year in my mind. I mean, I don't, we don't have anybody that sits out and writes out the letter or anything like that. I mean, this is a letter between partners, and I write the letter all year in my head. I'm writing next year's letter. I don't write out the words, but I have things I want to tell my partners. my sister's a partner, and I'm writing to her in my head. My older sister died not too long ago, but I used to be writing to both of them, in effect. And I want to tell her, what I think and about the business and what I think she ought to think about it and so on. So the letter's dated February 26th, and I said not much is going on. And actually, we might jump over to Q3, if we will. So I sent out a letter on February 26th, but that wasn't written on February 26th. And I said, basically, nothing much is happening around here. And I said, we've repurchased some shares, and we just aren't seeing anything. And between January 1st and February 18th, as you can see, we spent $2.2 billion, which is half the quarter, so probably 30 trading days in there. And we sold them. So that basically we didn't do anything. And then in the next 3 weeks or thereabouts, we spent $40 billion. And incidentally, when I say we spent $40 billion, there's one fellow in the office that does this all. I mean, he buys all the stocks, he buys the government bond. He doesn't have an assistant or anything. But he spent $41 billion. Yeah, and he literally, I mean, and he does other things for me too. He puts together totals. He just does what he needs to do, and he's worked in other jobs at Berkshire long ago, but he likes doing what he does, and he does it very well, and we don't have a department for it. Then, as you can see, it fell off after that, and we did also in the first quarter, we spent about 3.1 or 3.2 billion, somewhere in that, for repurchasing shares. And we didn't, we talked about that in the annual report. And as Charlie would say, it was keeping us out of bars. I mean, that gave us something to do. We never do anything that we don't think adds to the value of Berkshire Hathaway, though. So we only repurchase the shares when that is the most attractive thing to do. We haven't repurchased any shares at all in April. So it's people who were looking for all these prints in the, footprints in the woods and all that is what we're doing. We're just doing it day by day as it comes along. And I think this table kind of illustrates that we spent $40 billion in a hurry there between 3 weeks, and now we're back somewhat in our more lethargic mood. But anything could change at Berkshire. But the one thing that won't change, going back to Q2, if you'll, is we will always have a lot of cash on hand. And when I say cash, I don't mean commercial paper. When 2008 and 2009 financial panic came along, we didn't own anybody's commercial paper. We didn't have money market funds. We have Treasury bills. And as I may get into a little later, I'll explain to you why. We believe in having cash. And there have been a few times in history, and will be more times in history where if you don't have it, you don't get to play the next day. I mean, it's just it's like oxygen. It's there all the time, but if it disappears for a few minutes, it's all over. So our cash was down on March 31st because, as you saw, we spent that large sum there in that brief period during the quarter, $40 billion. We've committed to buy Allegheny Corp for something over $11 billion, and but we will always have a lot of cash. We don't. Some of our companies have bank lines. I don't know why they have the bank lines. We're better than the banks, and we'll give them the money if they need it. But the local bankers have been calling on them, and they need something to do. Everybody else has bank lines, so it's harmless. But there's no reason for any of our subsidiaries to have bank lines. Berkshire is stronger than the banks. I didn't hear exactly what I don't know whether that was a banker screaming or. I don't really like to torture. I don't like to torture anybody. I mean, but and I'm all for banks, and we'll talk about that a little later. In fact, we might even talk about it right now, just for a minute. Money's kind of an interesting thing. People seem to like to talk to me about it. I mean, they don't ask me how to dance or anything like that, but they do ask about money. And so, if we'll put up 20-1, it's a photo of a $20 bill, and it says at the top, Federal Reserve notes. Now, Federal Reserve note, we've done all kinds of things with money in this country. It's amazing, country only a couple hundred years old, the number of different experiments we've made with banks and everything. But we finally just decided to let the Federal Reserve do the issuing of money. And down in the lower left-hand corner, incidentally, I think Rosie Rios, who signed this note, I think she signed more U.S. currency than any other person in history. So if you see Rosie, you cozy up to her. I mean, this is a woman that has issued a lot of currency. But it says this note is legal tender for all debts, public and private, and that makes it money. You can go into our candy store, and if you offer us enough bushels of wheat, we'll probably give you a box of candy. But money is the only thing that the IRS is going to take from you. You can offer them all kinds of. You can offer them paintings. You can offer them all whatever. But this is what settles debts in the United States. And I thought that you'll hear a lot about various kinds of money. This is the only kind of money you're going to see, in my opinion, throughout your lifetime, or even throughout Charlie's lifetime. I mean, this is it's very interesting because it just says that settle all legal tender for all debts, public and private, and nothing else says that, except I thought you might be interested in seeing another $20 bill, and this one I own. And on that, it's got the same guy's picture, Andrew Jackson, and everything. And that's a $20 bill. And that $20 bill was issued during my lifetime, and it was done by a bank that Berkshire ended up owning. So you'll see the Illinois National Bank and Trust of Rockford. And we bought that bank back in 1969. And if you look down at the bottom of that one, it's signed by a fellow named Eugene Abegg. And we bought it from Eugene Abegg. So we still have some $20 bills that came in sheets, and we can cut them out like paper dolls. And they're our money. The Illinois National Bank issued money. But just remember, the United States government, in effect, said that this became exchangeable for lawful money of the United States. That's what money is. It may turn out that it becomes worth dramatically less in purchasing power, it can become almost like paper money, as it has in many countries. But that is all. When people tell you that they're issuing new forms of money, this is the only thing that will pay bills under some circumstances. And there were days, a few days in 2008, and we came very close to having a repeat in March 2020, and we had plenty of money on March 20th, but we were not very, very far away from having something that might have been a repeat of 2008 or even worse. And we have a bookstore here, but the Bookworm, that's in the other room, and they've got a book called $1 Trillion Triage. And for those of you who actually like to read about this sort of thing, it's a marvelous account of what took place day by day with the Federal Reserve and the Treasury. And believe me, if the Federal Reserve hadn't done what they did, at least in my view, in a very, very, very short period of time, things could have stopped. And I tipped my hat a couple of years ago to Jay Powell for acting as he did. You have to act with speed. I mean, in the old days when you had runs on banks, back in the 19th century, a line formed, and the bank would go broke. But the fellow would pay out as slowly as possible, hoping something would happen. A Wells Fargo truck or a stagecoach would pull up with a bunch of gold or something, and you'd sweet talk the people into the line dispersing. In Omaha, in August of 1931, 4 state banks, so-called state banks, they had in that day, they closed, and the national banks didn't. But they were all broke as of that day. No bank can pay off in one day all of its liabilities. But the Federal Reserve is the only one that's good at that time. But I will tell you this, Berkshire Hathaway will be there at that time. We run it on the basis that if things just behave slightly, if Frank Paulson, George W. Bush, I'm sorry, and Ben Bernanke, and a few people hadn't taken action, we were at that point where the line was formed, except it comes in electronic fund, they push buttons, and it's all over very fast if there's a run on a bank. If you ever buy a bank, and there's 2 banks in town, hire a few extras and have them go over and start standing in line at the other guy's bank. I mean, and there's only one problem with that. After a while, somebody will stand in front of your bank, and then both of you are gone. But the Federal Reserve is not gone. And the Federal Reserve in the United States can do whatever is necessary. They've got all kinds of rules about can do this or that and this and that. One time in the 1980s, Paul Volcker, who was a very honest man, said to me, and I said, what are the limits of what you can do? And he said, he was a very unusual guy and huge, looked out at me, said, we can do whatever we need to do. And that's true, and that's what happened in 2008 and 9, and that's what happened in 2020, and you'll hope it happens again next time, but you want to be we want Berkshire Hathaway to be there and in a position to operate when if the economy stops, and that can always happen. That can always happen. So with those cheery words, let's see if we. I think we can actually, might be a good idea to start with some questions. As I said, we will have the questions alternate between CNBC, Becky Quick, and those are questions that have come in from shareholders, and they can be directed to any of the four of us up here, and then we will go alternate and go around the room here, and we've got the auditorium broken into 10 or 11 sections. Charlie and I one time figured out a form and said officers of the company broken down by age, and we just put all of us as an answer to that question. But we'll have it broken down by categories around here, and we'll keep alternating, and we will break for lunch at noon and reconvene at 1. So let's start off, and Becky, will you lead the way?
Thanks, Warren. The first question comes from Jack Sisaleski, and he says in the annual letter that you wrote in February 26, you mentioned that Charlie and you saw little that excites us in the market, yet around March 10th, the deal for Allegheny was announced, and then later the Occidental announcement, then the disclosure of the HP investment. His question is, what changed from the time you dated the letter to the time the investments were announced? Did the name suddenly become interesting in the space of a month and a half, or half a month?
Well, Charlie, you want to give your version? I'll give my version.
Well, my version would be we found some things we prefer to owning to Treasury bills.
Yeah. And as usual, Charlie's given the total answer, but I'll talk longer and say less. Actually, the letter's dated February 26th, where we were confessing our inability to find anything, which was a Saturday. But the day before that, February 25th, I got a email. Actually, my assistant, Debbie Bosani, gets it because I can't figure out quite how to handle the machinery. But so she brought it in, and or actually she puts a bunch on the edge of her desk, and I collect them occasionally. And there was a note, just a few lines long, from a fellow that was a friend of mine and that worked for Berkshire a good many years ago. And this was on February 25th, the day before the thing. And he said he'd now become CEO of Allegheny Corp. I'd been following Allegheny Corp for 60 years. I read their annual reports. I had 4 big file drawers full of it because it was an interesting company, and all companies interested me. So I knew a lot about Allegheny Corp. And Joe said, this is my first annual report as CEO, and I just wanted to send it along to you, just like you write for your sisters. He says, I write this report as if I'm writing to you. And I sent a note back to Joe, and I said, I'm going to read it over the weekend or whatever I said to him on it, which was true. I mean, I look forward to reading it. And I said, by the way, I'm going to be in New York on March 7th, and can we get together? I'd like to see you. And I think I may have said I got an idea. Well, I didn't have that idea the day before. I mean, this thing happened to come in on Friday the 26th, and I knew I'd buy Allegheny at a price. And if he hadn't sent me the note, it never would have occurred to me to write him and say, why don't we get together on March 7th or anything of the sort. It just wouldn't have happened, except for the fact that Joe wanted to send me along this annual report that he'd just written. So that's the orderly and decision-making progress. I didn't call up investment bankers and say, will you prepare me a report on this, and what's your advice and all this stuff. I knew we'd buy Allegheny at the price we offered, and if it was of interest to Allegheny, fine. If it wasn't, but otherwise, if that email hadn't been sent, we would not have made an offer for Allegheny. So give credit to the fact that Joe had written the annual report, and if he'd sent it a week earlier, well, I wasn't going to make a special trip to New York, but I wanted to sit down with him and tell him what Berkshire would do. But that explains the $11 billion. And what happened was that a few stocks got very interesting to us, and we also spent a lot of money. What happened, the market, and this is really important to understand, in the last couple of years, the stock market is it's always been a combination of a casino and when I talk about Wall Street, I'm talking about the whole capital formation market, and trading market, et cetera. But the market has been extraordinary. Sometimes it's quite investment oriented, kind of like it always you read about in the books and everything, what capital markets are supposed to do, and you study it in school and all that. And other times it's almost totally a casino, and it's a gambling parlor. And that existed to an extraordinary degree in the last couple of years, encouraged by Wall Street, because the money is in turning over stocks. I mean, people say how wonderful you've done if you bought Berkshire in 1965 or something and held it, but your broker would have starved to death. I mean, it's Wall Street makes money on one way or another, catching the crumbs that fall off a table of capitalism and an incredible economy that nobody could have ever dreamed of a couple hundred years ago, but that they don't make money unless people do things, and that they get a piece of them, and and they make a lot more money when people are gambling than when they're investing. I mean, it's much better to have somebody that's going to trade 20 times a day and get all excited about it, just like pulling the handle on a slot machine. That's who you may not say that you'd want that person. You'd like the other kind of person too, maybe, but that's where you make the money. And the degree to which the market got dominated by that is shown on a slide I have here somewhere. Here's on Oxy 1. If you'll put up the Oxy 1, that shows how we bought what became. Well, we bought in 2 weeks, thereabouts, 14% of Occidental Petroleum. And you'll say, well, how can you buy 14% of a company in 2 weeks? And it's more extreme than that. Because if you look at the Occidental proxy, you'll see that the standard names, BlackRock, index funds, State Street index funds, basically, Vanguard index funds, and then one other firm, Dodge and Cox. If you take those four entities, and they're not going to buy and sell stock. They've got their own little rules. So they own 40% of the company, roughly. Those four firms, and they didn't do anything during this period. So now you're down to 60% of the Occidental Petroleum Company that's even available for sale. Now, Occidental's been around for years and years and years, big company, all kinds of things. And with 60% of the stock outstanding, I go in and tell Mark Millard, this fellow that is 30 feet away from Mearsal, and I say in the morning to him, buy 20% and take blocks or whatever it may be. And in 2 weeks, he buys 14% out of 60%. That's not investment. I mean, you're not buying from investment. I find it just incredible. You wouldn't be able to do that with Berkshire. I mean, you can't literally buy. You can say you want to buy 14% of the company. It's going to take you a long, long time. But overwhelmingly, large companies in America, well, all of them, they became poker chips, and people were buying and selling like 3-day calls or 2-day calls, and the more times people pull the handle on the machine, the more money the machine makes. I mean, it's very clear, and overwhelmingly, I mean, where did people go? The investors just were sitting around, and there weren't very many, and the money was being made essentially by a bunch of people gambling on things, and that enabled us in a 2-week period to buy 14% of a business that's been around for decades. And imagine trying to buy 14% of the farms in 2 weeks in this country, or 14% of the apartment houses, or 14% of the auto dealerships, or just anything, when already 40% were locked up some other place. It defies anything that Charlie and I have seen, and we've seen a lot, but I've never seen that percentage of the American public. Essentially, it was a gambling parlor, and the people that were making money were people that worked with gamblers. And then it declined very significantly a few weeks ago. You can feel it if you're around it. So when somebody asks a very good question is, why weren't you doing anything on February 20th, and why were you doing it on starting, well, in the case of Occidental, on February 28th? It's because things developed in a way, and in the case of Occidental specifically, they'd had an analyst presentation of some, I don't know whether it was a quarterly one or what it was exactly, but I read it over a weekend, and that was the weekend when the annual report came out. I read it over a weekend, and what Vicki Hollop was saying ain't nothing but sense, and I decided that it was a good place to put Berkshire's money, and then I found out in the ensuing 2 weeks, it was there in black and white. There was nothing mysterious about it, but Vicki was saying what the company had gone through and where it was now and what they plan to do with the money, and she'll do what she says. She doesn't know the price of oil next year. Nobody does, but we decided it made sense, and 2 weeks later we had 14% of the company, and we also already had a preferred stock and warrants. And the story of the preferred stock is we paid $10 billion. Preferred stock and warrants, we paid $10 billion for it. And at the end of the March quarter of 2020, we valued that $10 billion for our 10Q. We valued it at $5.5 billion. So we had a $4.5 billion loss, and it would have, the world changed. Oil sold for minus $37 a barrel one day, and now it's quite apparent, I think, that we're very happy. We should be very happy that we can produce 11 million barrels a day or something of the sort in the United States, rather than being able to produce none and having to find 11 million barrels a day somewhere else in the world to take care of keeping the American industrial machine working. Charlie, have you got any comments on that as to how something this crazy could have happened?
Well, it happened. It's almost a mania of speculation that we now have. We have computers with algorithms trading against other computers. We got people that know nothing about stocks being advised by stockbrokers who know even less.
I understand the commissions, though.
Yeah, it's just an incredible, crazy situation. And it's weird that we ever got a system where all this equivalent of casino activity is all mixed up with a lot of legitimate long-term investment. I don't think any wise country would have wanted this outcome. Why would you want your country's stocks to trade on a casino basis to people who are just like the people that play craps and roulette in the casino? I think it's crazy, but it happened, and it's respectable. Not with me, but with other people.
Yeah. Well, and look at what the country. I mean, they formed the New York Stock Exchange in 1792 under a buttonwood tree, and it really didn't seem like that was the eureka moment in America. But just look at what's happened using the system for less than, 3 of my lifetimes. I mean, it's unbelievable. So it's worked. Now, maybe it's worked in spite of itself, maybe with the country, but one way or another, America has worked in an incredible manner. Nobody could have dreamt it. Nobody. They'd have hauled you away if you said, in 3 lifetimes, that this place where we're meeting. I mean, it became a state in 1867, but 1789, it asked Ben Franklin or somebody that was walking out of the Constitutional Convention, what do you think the prospects are for Nebraska? It's unbelievable what's been accomplished, and it's been accomplished. The people who encouraged the gambling, they would like to say it's been accomplished because of we've got these liquid markets and all these wonderful things. Charlie would probably say it's in spite of that. Who knows? But the answer is that there isn't an answer. My wife, when they got married, April 19th, 1952, we got in my aunt's car, and we started driving west, and we ended up, drove all over the West, but one night we ended up in Las Vegas. And there were 3 fellows out there. Eddie Barrick and Sam Zigman and Jackie Gone. And all 3 of these guys were from Omaha. And they'd bought little pieces of the Flamingo. Bugsy Signal had his career ended rather abruptly. a few years earlier.
Bad bullet.
It was a stray bullet, undoubtedly. But in fact, there were probably 5 or 6 stray bullets. But in any event, Bugsy was gone, and some people, including 3 guys from Omaha, were in the group. Sam Zygmunt lived about 2 blocks from where I live now, and he was Stan Lipsey's uncle. Stan Lipsey ran, those of you who follow Berkshire, ran the Buffalo News and was a partner for 40 or 50 years later on. So all kinds of things intersect, but I walked into this casino or a Flamingo. It's kind of a motel-like arrangement. And I was 21 and my bride was 19, and I looked around the room, and there were all of these people, and they were better dressed then. It was a more dignified group than perhaps currently, but they'd flown thousands of miles in some cases, in planes that weren't as fast as the current ones and were more expensive, probably on a per mile basis adjusted. And they'd gone to great lengths to come out to do something that was mathematically unintelligent, and they knew it was unintelligent. And I mean, they couldn't do it fast enough in terms of rolling the dice, and trying to determine whether they were hot or whatever they may be. And I looked around at that group. Everybody there knew that they were doing something that was mathematically dumb, and they'd come thousands of miles to do it. And they were, and I said to my wife, I said, I'm going to get rich. I mean, how can you miss? If people are willing to do this, this is a land of opportunity. Well, it's the way it still is. And the Flamingo grew to be much bigger, and in Omaha, we're very proud of Jackie and things he did. He only died a year or 2 ago. He became sort of the leader, spiritual leader of Vegas. And like I say, Sam Zygmunt's nephew went on to save my and Charlie's investment that we made in Blue Chip in the Buffalo News. And, it's a very accidental society that occurs, but there's nothing stranger than what has happened in finance. On the other hand, if you go back, perhaps the greatest chapter ever written on the operation of markets, particularly the stock market, is in a book that's probably one of the most famous books in economic history, the General Theory, written by John Maynard Keynes. I think it was 1936. And I don't know whether it's chapter, I think it's chapter 12, but whatever it is, he describes what market's all about in 1936. And he describes something in beautiful prose that explains why the whole country in March of this year was sitting around trading Occidental in some crazy way that enabled us to buy a quarter of what wasn't owned by 4 other institutions that weren't going to sell. We were able to buy a quarter of it, and we could have bought a lot more. I mean, you just wondered if there was anybody that really was thinking about investment. Going back to investing, I mean, investing is laying out money now with the hope of getting back more later on. It's really laying out purchasing power now with the hope of getting more purchasing power back. But that's the reason that's the way you learn in the textbooks, that you defer consumption now so you can consume more later on so that you can take care of your family. All these things about how investment takes place. And that is what happens with farms. I mean, somebody buys a farm, and they hope to leave it to their kids, or they got it from their parents. And I mean, they don't sit there every day and get quotes 15 times a day and say, I'd like to get a call. I'd like to sell a put on the guy's farm next to me, and you can have a call on mine, and then I'll have something called a straddle or a strangle or whatever it may be. And they go about making the farm worth more money, and they do the same thing if they got an auto dealership, and they do the same thing if they've got an apartment house, they look for improve it and attract tenants, all those kind of things. And 40, what would it be, 40 trillion at least, of the ownership of all of the American business. People treat as poker chips, or pulling the handle, and they've got systems set up so that if you want to buy a 3-day call on a stock, you can do it, and they make more money selling you calls than if you buy stocks. So they teach you about calls. Nobody's going around selling calls on farms or anything of the sort, but that's why markets do crazy things, and occasionally Berkshire gets a chance to do something, and it's not because we're smart. It's because the only thing I'd say we qualify on, and sometimes I wonder about that, but I think we're sane. I mean and that's the main requirement in this business. And anybody, Charlie? Yeah.
Well, I don't think we've ever had anything quite like what we have now in terms of the volumes of pure gambling activity that go on daily, and the people lathering the gamblers up so they can rook them. And it's not pretty, and I don't find it creates any great glory for capitalism or anything, any more than a bunch of people throwing dice at a table. What good does that do the rest of the world?
It's a great way to become rich, though. Just figure out ways to insert yourself into the system somehow. And jobs to some extent self-select. And many years ago, and I've got all kinds of friends in Wall Street. Not as many as I had before I had started talking this way an hour or so ago, but I really do. People make lots of decisions in life, and the truth is that overall, the American system has worked extremely well. It may be very unfair in many ways, but it has produced incredible difference in the goods and services available to me versus what my grandfather had available. I do not want to go back to pre-air conditioning and people pouring whiskey down me while they drill my teeth or something of the sort. I mean, this is a lot better world, and
I think we've made more because of the crazy gambling. I think it's made it easier for us net over the decades we've been operating.
Well, I mean, we've depended on it.
Yes.
I mean, we depend on mispriced businesses through a mechanism where we're not responsible for the mispricing of them. And overall, we learned something a long time ago that doesn't take a high IQ, doesn't take anything. It just takes the right attitude. We may talk more about that later, but I think we ought to prove that we've got an audience here by going to section 1.
Good morning. My name is Ole Pollem. I live in Hanover, Germany. This is my first time in Omaha. My question is on Berkshire buying entire companies outside the US. There were a few, Iska probably the first one, Louis in Germany. My question is, would you only answer calls from them if you're interested in, or would you proactively approach them if they would like to sell their company?
We actually made a few trips. I think maybe Charlie went with me on one of them. We tried to stir up interest and all that sort of thing in Berkshire around the world. We probably did that 20 or 25 years ago. During that period that I showed you, that burst of action we had, we probably spent at least $5 billion of that. Yeah, it'd be pretty. in the area of $5 billion of it. We bought 3 German securities. We bought 2. Well, we bought 1 Japan. We rounded up on some of the holdings we already had there. We would love to buy it, but they don't think of us as quickly there. I mean, I don't have somebody that's going to send me an email about a company that I've been following for 60 years, and I know I can see him in New York, and I can name a number to him, and if he likes it, he can take it to his board and so on. And it just doesn't happen that way. We haven't had that experience in anywhere outside the United States. Now, you can say with 40 trillion here, we should be able to find something here a little closer to home. But we don't have any bias against doing it. There are companies, we'd buy in 10 minutes if we had somebody on the other end that could do business in 10 minutes. It's much more complicated in certain countries than in the United States to purchase businesses, and there's certain rules. But I would say this, we got a call, whatever it was, many years ago on our company in Germany, and actually the two fellows that run it are probably here in the audience. I saw them yesterday, and they're marvelous, and they run the business, and they're as trustworthy as all the pictures were up on the movie we showed before the meeting started here. We have so much trouble finding good ideas that we can't afford to ignore any, but they do have to be sizable now. I mean, there really isn't. There isn't a lot of. I love the operation we bought in Germany, and it's just a pleasure to be associated with the people there. I just wish we could add another 0 to all the figures. It was a much larger deal. It's not going to have an economic impact on Berkshire, but they love it. They care. You can see it. You can feel it. And that's the kind of business we'd like to have, and we're very happy we've got it in Berkshire. But we can't do it one debt of Louis at a time. And we would never sell an operation like that, ever. I'm looking at you, Greg. But if we get a call tomorrow, and we could make a deal that involved $10 or $20 billion that was in Germany or France or Britain or Japan or name a whole group of countries, we'd do it. We bought the interests in the 5 leading trading companies in Japan a couple years ago, and I rounded them up a little bit, but I told them originally we weren't going to buy a lot we weren't going to change our positions materially without their okay. So we actually, I think, rounded to 5.85%, based on the latest figures we had then, of all 5 of them. And that put a good many hundreds of millions, or maybe $1 billion or $2 billion, to work. So we will, President Kennedy said, we'll pay any price, climb any hills, whatever it may be, to find businesses. But we actually prefer it when they fall into our lap, like getting a letter from somebody and you hadn't heard from them for a couple of years, and you know what you pay for the business, and if the board of directors of that company regards it as attractive, that they'll be happy to buy it, and they know you're going to show up at the closing and that you're not going to pile debt on it or change things or anything. They've got an answer, and then you have to see if they've got the question in their mind is what's the best thing for for Allegheny Corp. And in that case, we had $11 billion less at the end of the day, or at the end of the dinner, than we had at the start of the day. So opportunity can be any place, and we do have a terrific operation, for example, in Israel. I mean, just terrific, and it's pretty good size. Would we like to have another one like it? Yeah, I just don't know where the other one is. Charlie?
Well, but think in the scheme of things, imagine buying in $60 billion worth of our own stock. We like the businesses. We like the price we're paying. No overhead, no cost, no nothing. Just more interest in what we already own. Isn't that we're totally wasting our time?
Yeah, and if you look at it, you can read hundreds of thousands, maybe millions of words written on stock repurchases and what this is and what that is and all this kind of thing. It's not very complicated. I mean, if you had a partner in a lemonade stand and they wanted to sell their interest, or two partners and one wanted to sell their interest, I mean, and the business had the money to buy it, our little lemonade stand, and they were offering it a price that was good for the other two people that are going to remain, you'd buy it. Now, the thing that is fascinating to me is what you can accomplish, and still people don't pay any attention to it. We owned in 1998, this is more than 20 years ago, we owned about 150 million. I don't know whether they've split, whatever it is, if they've split it, split adjusted, but we owned 150 million shares of American Express. I think we bought our last share in 1998 or something like that. So, and we then owned 11.2% of the American Express company. Wonderful company. And since then, they've sent us a check every quarter as a dividend. And so we've taken some cash a little bit as they've gone along. And now we own 20% of American Express. That's what's happened because they've repurchased shares. That happens to have worked out extremely well. If they overpaid for the stock and all that, it doesn't solve every problem, but it's a wonderful thing if you've got an asset you like and they take your ownership interest up. And like I say, we've gone from 11.2% to 20%. If you're using your American Express card, or whatever it may be, 20% of whatever earnings are attributable to our interest, and they used to be 11.2%, and we've done it without putting up any money. Now, imagine if you owned a farm and you had 640 acres, and you farmed it every year, and you made a little money on it, and enjoyed farming, and somehow, 20 or so years later, it had turned into 1,100 or 1,200 acres. I mean, you'd say, how long has this been going on? What could possibly be, is this un-American or whatever it may be? I mean, is it, sensible use to meet its cost of capital, blah, 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 blah. And if you do it at the right price, there's nothing better than buying in your own business. I used Apple as an example of how our interest in Apple, every time a company that earns $100 billion a year, it means that our interest in it goes up 0.1%. We've added another $100 million to earnings. Well, it takes a lot of work to add $100 million to earnings. And in the first quarter, they just reported, they're on a fiscal year, but they just reported their March quarter, and they earned more money, and they had fewer shares outstanding. And we actually bought a little more Apple in the first quarter. So we decided we wanted to own a greater interest, And on top of that, we knew that we would own an even greater interest if they kept buying in their shares, which we didn't have any insider information or anything, but certainly would seem the way to bet. And we feel better because we bought the shares we bought in the market, and we feel just as good as by the fact they use their cash to buy out some of the other people. It is the simplest thing in the world, and then I read all this stuff. It is unbelievable how people can't figure out something that, if they owned a farm and the guy next to him had a farm, and somehow you were getting more of his farm all the time without putting up any money while you farmed your own farm, that at least if you're using some of the earnings for that, you'd feel very good about it. Have you got any explanation for it, Charlie?
Well, I have another thing that interests me in the present scene. We get all these suggestions from index funds, a letter saying the chairman and the president of the chief executive officer are the same person, and that they have some professor somewhere that thinks that American business would work better if it had a separate, if Warren could split him in two and have each half work. And to me, it's the most ridiculous criticism I ever heard. Odysseus would come back from winning the battle in Troy and so forth, and some guy was saying, I don't like the way you were holding your spear when you won that battle. There's some guy that's never run any business and doesn't know anything. I don't think too much of this activity.
Well, let's see. Somewhere in here, I may find it at some point. Oh, here it is. We wrote in the annual report that in the third paragraph of a 9-page report, we said, we're going to treat everybody the same. It may be a crazy concept we have, but we really feel that somebody that gave us their savings in 1960 or 1970 or 1980 and just left them with us and trusted us, we feel that they're entitled to the same sort of respect and attention that somebody that is accumulating like crazy assets under management gets paid based on assets under management, that knows that they just need to have policies that essentially are popular in Washington. The only threat they have really is that Washington sometimes says that you're getting too damn big and we're going to do something about you. So they try to be very sure that they're doing things that people will share. So anyway, I say, well, we're going to treat you all alike. We've got 3 million people or shareholders out there. We're going to treat you all alike. And on March 25th, about a month after I wrote that letter, it's in the third paragraph. You'd think that they would get that far. They had 101 million B shares. I mean, somebody ought to read to the third paragraph. But anyway, we got a letter and says, we would like to meet with you in advance of Berkshire Hathaway's 2022 annual meeting of shareholders to discuss Berkshire Hathaway's perspective on governance and sustainability. Well, I've written probably more on that that's been honestly written by the guy who runs the company, but why in hell would they think that we should meet with them and not you people all individually that come here? I mean, it's, I grew up in a very, very, very Republican household, but I feel like some raving populist or something, but I just can't imagine. Well, anyway, you've heard it. Somebody gets paid to well, there's a lot of people, I'm sure, in public relations, and they hire advisors because it looks better if they have advisors that tell them whether the chairman and the CEO should be the same person or not, and those people get paid for it, and then they discuss it at their board meeting, and then, in the end, believe me, if 90% of Congress for some reason felt it was better to have the chairman or the CEO be the same person, the index funds would not be writing those letters, because all they have to worry about is whether, for some reason, people start wondering why some institution should have 10% of the votes in every major corporation in the country. And I like the idea of index funds, but it is interesting to watch where incentives and bureaucracy and whatever it may be lead people. The guy that wrote me the letter is probably a very nice guy. But that's his job. And well, anyway, they didn't get a special meeting. And you people are here, and we appreciate the fact you're here. Okay, back to Becky.
This question's for Ajit and Greg. It comes from Ben Nall, who's a shareholder of 30 years. He's a Nebraska native, and he says he'll be attending the meeting here today. BNSF and Geico appear to be losing ground to their two primary competitors, Union Pacific and Progressive. Over the past several years, UP's operating ratio has been about 400 basis points better than BNSF's, and Progressive has grown faster while maintaining a lower combined ratio than Geico. On an operating basis, UP's precision scheduled railroading and Progressive's telematics appear to have jumped ahead of the Berkshire businesses. He wants to know what Greg and Ajit are doing to address those business challenges.
You go first. Okay. Thank you, Becky. Let me just start by saying when we think of BNSF, we have an exceptional franchise there and a great business. And we do compete with other railways, and we're very well aware of how they operate, including their operating ratios and the metrics they operate to, and precision railroading, and it's all part of it. But what I would share with is when I think of BNSF, we start with focusing on our customer, understanding how we can best service them, and yes, we want to do it in an efficient, effective way that delivers great results back to our shareholders. And that will continue to be our focus. So yes, we learn from all the metrics they report and how they operate their rail, and we observe it. But I would put our team up right beside them on any operating day, and we're gonna move our rail cars as well as any other rail company in America, and we're gonna do it on behalf of our customers. So we're very proud, but we're not ignoring the fact that there's more to be done, both operationally and for our customers. So we'll continue to see improvement there. We've got a great leadership team there. We've got a great employee group within BNSF. And what I like is we're just gonna see long-term improvement there. We have an exceptional intermodal franchise out of the West. It's incredibly valuable to our shareholders long-term, our partners. And that's what our team is focused on, building that franchise out. So couldn't be more proud of where we're at, but we also know we have a journey ahead of us, and we're going to continue to get better and better.
Greg, if we were ever the opportunity, would you trade our operation for theirs?
Never, never. And we love
He knows a lot about it, Phil.
We have a great franchise, and we have a great leadership team running it. So, well said, Charlie. Thank you.
And I just, before we go to Ajit, and Greg, was a major partner for 20 years, more or less, since a little over that, since we bought the energy company, and his boss was Dave Sokol, and the two of them, I mean, they knew how to run businesses. I mean, and they, it isn't like we don't read what other numbers are and all that, but we've got the perfect person running, and Katie Farmer, we've got the perfect person running BNSF, and she'll do a great job, and changing around a railroad in various ways. If you got 1,000 or something miles of own track and all kinds of other, it doesn't count sidings and double tracking, and you've got a lot of things to do from something that they started building a couple of hundred years ago, and you, not quite a couple of hundred, and you can't move things around very easily, and towns grew. When you came into Omaha in 1862, well, the railroad didn't even go across the river. I mean, even though we'd become a major rail center for the West, or the opening to the West, and we're going to be here 100 years from now. We will be an important, a really vital asset of the country, and it will be a very big part, very important part of Berkshire, and we will take what is an incredible assemblage, I think, of 300 and some railroads or something over time, and the tracks got laid, and the routes laid out. 150 years ago, the world changes, but we have to adapt to it. But you don't put an order out to change 1,000 miles of track and how it's operated or anything of the sort. So we're running it to have that asset for Berkshire shareholders, and it will redundant to the benefit of the country. And if we do it, well, no matter who ran it, would be important, obviously enormously to the country. And the UP will be here and at that time too, and it'll be a better railroad 100 years from now than it is now. But I can't promise you what will happen if we get flooding and something in the next few months. It can wipe out a lot of the plans you have and disrupt lots of lives and disrupt lots of shipments. And there are no magic wands in railroading to make great changes. On the other hand, you ought to be working at it every day to make it better. I forget how many bridges we have, but some years ago, we were spending $3 or $4 billion a year on capital expenditures. And one, I said, Matt Rose, I said, this is a lot of money to spend, keeping up a railroad. And then he said, well, we're going to have to do that and more and so on. And I said, I can handle this, but I'm not sure Charlie can. I mean, I have to explain these numbers to him. So the next bridge they built, they called the Charles T. Munger Bridge. So you can actually go see. Our railroad has the Charles T. Munger Bridge because Charlie kind of was asking similar questions 10 years ago. Ajit?
Okay. Thank you, Becky. There's no question that the personal automobile insurance business is a very competitive business. Having said that, both Geico and Progressive are two very successful competitors in this segment. Each one of them have their pluses and minuses. But having said that, there's no question that more recently, Progressive has done a much better job than Geico, as you point out, both in terms of margins and in terms of growth rate. There are a number of causes for that, but I think the biggest culprit as far as Geico is concerned, and again, you rightly pointed out, is telematics. Progressive has been on the telematics bandwagon for, I don't know, more than 10 years, probably closer to 20 years. Geico, until recently, wasn't involved in telematics, and it's been only the last 2 years that they've made a very serious effort in terms of using telematics for segmentation and for trying to match rate and risk. It's a long journey, but the journey has started, and the initial results are promising. It'll take a while, but my hope and expectation is that hopefully in the next year or two, Geico will be in a position to catch up with Progressive in terms of telematics, and hopefully that'll then translate into both growth rate and margins.
Charlie, you got It's very interesting. I mean, the auto insurance industry is a fascinating one to study. In that the largest auto insurance company now, and we're talking 2022, and Henry Ford. I mean, it was 1903, or something when cars really got started, and it wasn't too many years after that he was turning out 2 million cars a year. Imagine that, one guy, 2 million cars a year is a lot of cars. So car insurance became very important after hundreds of years of when people thought about insurance. It was ships at sea and fire where they had protective societies, and insurance as a product's been around a long time, but auto insurance has been pretty much the same thing since Leo Goodwin started Geico in 1936, and we came along with a good idea and lots of big companies and all that. But the largest auto insurance company in the United States was started over in Illinois by a guy who didn't know anything about insurance particularly, and it's a mutual company. It's not supposed to succeed in capitalism. I mean, if you go to business school, they teach you that only because you have incentives and compensation and all kinds of things can a company succeed. Well, nobody's really gotten rich off State Farm. They've sat there, and they are the largest insurance company. While Leo Goodwin started 80-some years ago, and he probably wanted to get rich, and probably at Progressive, people wanted to get rich, and at Travelers and Aetna, and name off dozens and dozens of companies. And who wins? A mutual company. In terms of present size, they still are the largest company. They have, if you leave out Berkshire, they got the largest net worth by far. I think they've got $140 billion or something like that of net worth. And Progressive has had a very, very, very smart guy running it for a very long period of time. They got very smart people running it now, but they have a net worth that's 1/6 that of what some people over in Illinois that nobody knows the name of have after years of, they've had the time to sell the same product, and they advertise like crazy. We spend $2 billion a year telling people the same thing we've been telling them for 70 or 80 years. The policy doesn't change, but when we get all through, State Farm's still doing more business than anybody, and it shouldn't exist under capitalism. If you went there with a plan to start a State Farm today and have it compete with Progressive, who would put up the capital? I mean, a mutual company that you're not going to get the profits from, it doesn't make any sense at all, except they've got $140 billion or something like that of net worth. And Progressive, I don't know what their net worth is, but it must be somewhere around 20 or so billion. I haven't looked for a long time. Their net worth in the first, incidentally, I mean, they are very, very, very disciplined in underwriting. And of course, on the investment side, their net worth dropped in the first quarter because they own a lot of bonds. And they say, well, probably everybody in the insurance business would say that, well, we own bonds because that's what people do. And here's half the business where you do what people do, and the other half the business, you spend all kinds of time trying to analyze in every county and every single way you can segregate and properly rate business and all of that. And basically, Peter Lewis sat in my office 40 years ago, and he's smart as hell. And this guy was clearly going to be a major competitor of Berkshire's, and he knew insurance backwards and forwards, and very bright and everything, but he just ignored the investment side. And that was as important as the underwriting side. And it is interesting how organizations function and have what I would say are, to some extent, blind spots. And of course, Charlie and I know we've got all kinds of blind spots ourselves. So we have to be kind of careful of criticizing other people for having them. But the auto insurance business ought to be studied in business school because it essentially refutes so many of the things they're presently teaching. So that's my suggestion today to business schools. Okay. And thanks, Ajit. Ajit is responsible for adding more value to Berkshire than the total net worth of Progressive. That's not to knock Progressive. I'm just saying one guy. Okay, station 2.
Hello, Warren and Charlie. It is great to see you both and the wonderful Berkshire managers. Our thanks for everything that you do. My name is Rajiv Agarwal, and I am from New Jersey. My question is on market timing. You have always said that it is impossible to time the markets. Yet, if we look at your track record, you have had amazing timings with some of your key decisions. You got out of the stock markets in 1969-70. You got back in 72, 72, 74 when the markets were really cheap. You did the same thing in 87, 99, 2000. And today, we are sitting on a significant amount of cash when the markets are going down. My question is, how do you time the big market moves so well?
We'd like to offer you a job first.
I will take it.
The interesting thing is, obviously, we haven't the faintest idea what the stock market is going to do when it opens on Monday. We never have had. We have never made, Charlie and I don't think, in all the time we've worked together, and I'll tell you something later on maybe about how learning takes place, but we have never, I don't think we've ever made a decision where either one of us has either said or been thinking we should buy or sell based on what the market is going to do.
No.
Or for that matter, on what the economy is going to do. We don't know. And the interesting thing is, sometimes I get some credit someplace for the fact that, how wonderful it was that we were optimistic in 2008 and when everybody was down on stocks and all that sort of thing. We spent a big percentage of our net worth at a very dumb time. and I shouldn't say we, it's I. We spent about $15 or $16 billion, which was a lot bigger to us then than it is now. We spent it in the last few weeks. There was a period of 3 or 4 weeks between Wrigley and Goldman Sachs and General. At a terrible time, as it turned out. I mean, I didn't know whether it was going to be a good time or a bad time, but it was a really dumb time. And I wrote an article for the New York Times and Buy America and all these things. Well, if I'd had any sense of timing and waited 6 months until, I think the low was in March, and in fact, I think I was on CNBC maybe that day or something, but I totally missed that opportunity. I totally missed, in March of 2020. We have not been good at timing. We've been reasonably good at figuring out when we were getting enough for our money. And we had no idea when we bought anything well, we always hoped it would go down for a while so we could buy more, and we hoped even after we were done buying and ran out of money that if it was cheap, the company would keep buying, and in effect taking our interest up. I mean, that's stuff you could learn it in fourth grade, but it's not what's taught in school. And I mean, so never give us any credit. Well, actually, give us all the credit. I mean, go out and tell everybody how smart we are, but we aren't. We haven't ever timed anything. We've never figured out insights into the economy. I mean, when I was 11 years old, March 12th, I guess, 1942, March 11th, I bought stock when the Dow was 90, well, it was 101 in the morning. It was 99 at the end of the day, I think. And, now it's 34,000, or maybe it's 1,000 less than it was on Thursday. But I just, it's one decision that it's a good thing to own American business. And if the Harvard endowment had come to see me, and it's 11-year-old, or General Motors pension fund or something, and they say, well, no, but we have to have a balance, and we have to maybe have 60%, and then we have to sit around every 3 months and listen to a bunch of managers. They'd have just done better if they'd just taken some darts and thrown them and just said, we're going to be in America 50 years from now and 100 years from now, and we'll do better in stocks than we will in bonds. It's amazing how hard people make what a simple game it is. But of course, if they told everybody what a simple game it was, 90% of the income or more of the people that were speaking would disappear. So there's really a little too much of us to expect of human nature that people will explain why they really aren't adding any value to what you can do by yourself, or actually I hate to use the example, but you can't have monkeys throwing darts at the page and take away the management fees and everything. I'll bet on the monkeys, but I don't consider them a superior species, and I don't want them to move next door instead of my next door neighbor or anything. But that is the way it's just the way it has to be. Charlie, do you have anything cheerful to say?
Well, frequently in the wealth advisory business, the way it used to be, you go to your investment advisor and you say, what should I do to protect myself for the future? And he says, why don't you give me $50,000 of your net worth now? That's my contribution to your future. It's a peculiar business.
Yeah, it's a great place to go rich. It's still, if you have a son or daughter that really wants to make money per point of IQ and per erg of energy and all of that, tell them to go to Wall Street. I mean, don't have them enter the priesthood or anything. I mean, if that's what they, it self-selects, and it always will be the case. I mean, there's no reason to despair about humanity because they behave in their self-interest. They may not actually be behaving in their self-interest over time, but they, are they happy or who the hell knows? But if they just want to make money, people here in the auditorium saw a little session from the Solomon episode, and Jerry Corrigan was then the head of the New York Fed, and that same committee was grilling him, and they said, Mr. Corey, they were giving him a hard time. And they said, who was the highest, they said something to this effect, who was the highest paid or guy at Solomon last year? And he said, well, and he named him. And he said, maybe he named him. And he said he got, I forget whether it was 20 million last year. And we're talking 1991 now, too. He said, he got 20 million. And the guy says, well, how old is he? And he said, well, I think he's, Corrigan said, somebody affected. He's 26 or something like that. And then Corrigan couldn't resist saying, and he can't even throw a football. And the truth was, now there's a lot more money in throwing a football now than there used to be. One of my heroes was Ted Williamson. I think he was making $20,000 or $25,000 a year, and just imagine today, some guy that bets 230 or 240, and if he makes it to the bigs, I mean, the money flows in, and of course, those people should sit down and thank the fact that the stadium that could hold 30 or 40,000 people and was the source of revenue for the people who paid their paychecks, that stadium went from 30 to 40,000 because somebody first invented television, and they came up with cable television, and they came up with pay and all that sort of thing. And nobody knows the names of those people. But capitalism is very, very, very peculiar in how it dishes out rewards. And for a while, it was better to be in Wall Street than be at 220 or 230 hit here in the bigs. And it is now reversed because of the development of TV, et cetera. So it's a crazy world. Rewards seem very, 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 very capricious, and they are. And they don't seem to any theologian or even to Charlie and me in our spare time. The whole thing seems kind of crazy, but it's worked awfully well. And even the people who don't take advantage, get shortchanged by the system, are doing far, far better than if the system hadn't gotten changed. Doesn't mean that you necessarily shouldn't work for change, but you should recognize the limitations of what you can do with humans, I'll put it that way. Okay. Charlie, is there any way you'd like to close the sermon?
Well, I do think we have a very interesting phenomenon I would argue that in a lot of the wealth advisory business, people are charging for skill and delivering closet indexization. In other words, nobody can stand being that different from the crowd in results. They're afraid they'll lose their fees, so everybody does the same thing. It's mildly ridiculous. The world is mildly ridiculous.
Yeah. Mm-hmm. But as Charlie pointed out in the movie, which only the people here saw, that before we were married, we tried to convince a couple of young women that we were really more attractive than we were. I mean, you can't expect people not to behave with their self-interest, and that was very important. That we didn't disclose all of our weaknesses before the marriage. So,
Warren, we're trying to be a little better.
Yeah,
we may fail a little, and I don't know about you, but I've slightly improved since I was 17.
Yeah. Well, that's a really interesting point, because if fortune has just showered you with all kinds of good things, you ought to be a better person in the second half of your life than the first half. I mean, really should not be asking too much of people if they've if they've won the ovarian lottery and all kinds, they're born in the United States and all kinds of good things have happened to them, and you've had a chance to see how stupid you were in all kinds of things you did. Why not have the second half of your life be better than the first half? I mean, and I would say, working from a very low base, but I mean, I'm not nearly, by any intelligence test or ability to do any of that, I haven't learned anything, but you do learn certain things only by interacting with people. And you don't know when you're 2 years old, no matter how much you're picking up all kinds of knowledge from the world. The learning machine that's going on in a 2-year-old's head is just unbelievable. But it's not the same as having 30 or 40 years of experience with actually how the human animal behaves, which is that you really, you're learning all the time about it. But that should make you a better person in the second half of your life than the first half. And I would say that if you say you're a better person in the second half, if you've got reason to say it in the first half, forget about the first half. Enjoy the second half. And I think both Charlie and I have had the luxury of living a long time, so we get to play what we would regard as the hopeful and respectable second half. And we have had enough sense to figure out, we figured out what makes us happy, and we've gotten somewhat more sensitive to what can make other people unhappy and all that sort of thing. And I'd rather be judged by the second half of my life than the first half. And so would Charlie.
Yeah, of course.
Okay.
I don't even look at what I did when I was young because it would embarrass me.
Yeah. Okay. Any of you who wish to quiz Charlie on specifics can do so later. Becky.
This question is, there's a two-part question. It's for Warren and Ajit on the first part and for Greg on the second. It comes from Roger Cleffman. He says, several years ago, Mr. Buffett was quoted that a nuclear attack is the greatest risk to Berkshire Hathaway Insurance. Given the present circumstances, what would the fallout be on Berkshire Hathaway Insurance if a nuclear event occurred in the populated world? And then secondly, for Greg, has Berkshire Hathaway Energy suffered any physical or cyber attacks? And irrespective of that, has any special hardening of security been put into place?
Yeah. Well, the first half, every day since August of 1945, every day, and accelerating dramatically when a second large country had the ability to kill millions of people, which has been magnified by an incredible factor. The truth is that there is a risk every day. It's a very, very tiny risk, but as Ajit, anybody at this table could tell you, if you roll, well, they had a pair of dice out of the Desert Inn in Las Vegas for a while under a glass thing, and some guy had thrown 32 passes in a row, and I don't know what, maybe the odds are 8 million to 1 against that, or 4 million to 1 against, 4 billion to 1 against it. But if you just keep rolling the dice, everything will happen. I mean, if get 330 million Americans out tomorrow, every American says heads or tails, and they do it every day. After 10 days, you've got 330,000 of them that have called the flip 10 times in a row, and if you do it 10 more days, you've still got a bunch of people who've done it 20 times in a row, and they really think they have learned how to control the flip. Well, the answer is the world is flipping a coin every day as to whether people who can literally destroy the planet as we know it, will do it. And the major problem is with people that have large stocks of nuclear weapons and ICBMs. When they talk about using tactile nuclear weapons because somebody will be upset because they're losing a war, I mean, does anybody think that somebody's willing to kill, hundreds of thousands of people with tactile weapons? I mean, why do they stop? But if they're, it is a very, 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 very dangerous world,
but we don't have any way of protecting
There's no way
against
to
a big nuclear attack. I know a man who said, I know what I'm going to do if there's a nuclear war. I'm going to crawl under the table and kiss my ass goodbye.
Well, yeah, and Charlie is in charge of loss control at Berkshire. We have no solution for it.
No, we don't.
And there isn't any solution for it. And, it's extraordinary when you think about it. In August of 1939, September 1st, as you all know, Hitler moved into Poland, but nobody really knew that much about it here. I mean, the news you got from the newsreel you went to because the theater was air conditioned, or something. So if I went to the movies, which you wanted to do in the summer because it was air conditioned in August, September 1st in the case of the actual movement into Poland. But there was a few people on the screen and some guy with an authoritative voice telling you the German forces are just moved into Poland, and picture of a few tanks maybe. And it was over in a minute. Now, of course, all day, every day, you see people dying who you very much empathize with, and it could be you instead of them, and it's just so different. But in August of 1939, there was a letter sent to President Roosevelt about a month ahead of time. And why did he get that letter? He got the letter because Hitler was so anti-Semitic, basically. He drove all the Jews that could see it coming out of Germany, and among them were some great scientists. And Leo Szilard, who was, I think, obviously from Hungary originally, but somehow he got driven out. Einstein got driven out. And Leo Szilard lands and eventually in the United States. And he writes a letter to tell the President of the United States, Franklin D. Roosevelt, that there's a bunch of uranium moving different ways or whatever it may be. I don't know anything about physics, zero. I don't know what the off and on sign is. But in any event, I know what the letter did, because he writes a letter and says, something big may happen in physics, and America better get to it first. But then he has the problem of, how do I get it to Roosevelt? Leo Szilard, who's he, the President of the United States? So he figures if he gets Einstein to co-sign it, that the President will pay attention. And he's right. So he goes and gets Einstein, and the two of them send the letter, and they send it to Roosevelt, and they wouldn't necessarily have been in the United States if it, Hitler had a different, hadn't had the crazy views about Jews, basically. And so anyway, that letter went, and we developed the atom bomb before anybody else did. It was a very, very fortunate development that Leo Szilard and Einstein happened to end up in the United States rather than perhaps be someplace else. Who knows? But the accidents of history. And there's going to be more accidents in connection with atomic weapons. We've come close for various times. I mean, we had geese flying over, somewhere up north, and NORAD gets a crazy signal. And we've had wrong training tapes placed when we're in the Soviet Union or it looks like things are going on, and we can't do anything about it. And that is one risk that Berkshire absolutely has no interest in, even though you can say everybody in the world should have an interest, but it doesn't do us any good. The feeling doesn't do us any good to think about it. But that doesn't stop the fact that there are two powers in the world that, through miscalculation of the other's intentions, through all kinds of things, have come close in the past. And Charlie and I lived through the Cuban Missile Crisis, and we knew there was some chance that weapons of mass destruction would be used. And believe me, there's a lot more bad that can happen. And humanity has not really come up with a counterforce to technology. I mean, if you live back in the caveman ages, if you were a sociopath or something, you threw a rock at the guy in the next cave, or something. I mean, it was sort of proportional to, and we kept developing, and there was this breakthrough where technology has totally outrun humanity, and we'll see what happens. But so far, so good. And Berkshire does not have an answer, though. There's certain things we don't write policies on because we wouldn't be able to make good on them anyway, for that. And everybody would know we wouldn't be able to make good on them. So you have that risk, and there's nothing Berkshire can protect you against. And we've been very lucky so far. Ajit, do you ever get any questions in terms of?
In addition to all what Warren has said in terms of the chance of something like this happening, the additional thing that concerns me about a nuclear situation is my lack of ability to really estimate what our real exposure is in the event of a nuclear event. When you're talking about other big exposures we have, earthquake and hurricane and cyber, I can, with some reasonable degree of accuracy, have a point of view in terms of how large our exposures can be and how big our loss can be. When it comes to a nuclear thing, I sort of surrender. It's very difficult for us to estimate how bad can be. Very many different lines of exposures will be affected by it. And even though in almost all our contracts we try and exclude nuclear as a covered peril, nevertheless, if something like that were to happen, I'm fairly positive that the regulators and the courts will hold it against the insurers, and they'll rewrite the contract and we'll be required to pay. For example, one thing which is already being talked about, we issue what are called fire policies. And these fire policies try and exclude nuclear as a covered peril. But there are several regulators who feel that, gee, if it's a fire policy and if the nuclear attack causes a fire, then how can you exclude fire? And you better include fire. So, debates like that we will have to live with, and it'll be very difficult for the insurance industry to fight back both the regulators and the court systems in terms of what is covered and what is not covered.
And there won't be any regulators or anybody else. So we'll leave it to a million years of reconstruction. Einstein said, I know not what the weapons will be for World War III, but I know the weapons for World War IV will be sticks and stones. There's a lot of things. I mean, it just, if you're worried about the effect of nuclear attacks, you got other things to worry about than the value of your Berkshire. I'll put it that way. and what other cheerful things? Station.
Warren, you want me to touch on the cyber?
Oh yeah, sure.
Yeah, I'll just touch on the cyber because it was raised. And when you do think of Berkshire, and they use Berkshire Hathaway Energy as a reference, but cyber risk and managing that risk, both at Berkshire, really falls across all of our subsidiaries. And it's a constant risk that's there. It's one of our greatest risks we're always evaluating and trying to literally defend against. And if we use Berkshire Hathaway Energy as an example, we would receive billions of attacks every day against our various operating systems. So that's basically what our team is in place for. Both they harden the assets to deflect it, and then evaluating the underlying attacks we have, every second of the day. And by the way, that would we'd have a number of operating subsidiaries that experience that, but obviously it's the rail and the energy and a few others that we spend a lot of time on, a lot of effort, a lot of resources. And the good news is that through to today, our teams have done an exceptional job. We really haven't had a significant event. We've had some minor events at small businesses, but across our major businesses, across our major operating systems, we've had the proper security protocol in place to avoid events, but it never stops. Our team would tell you that every day that's a risk they recognize and a risk they're addressing within the businesses. So a significant risk, but a significant priority for all of our operating teams.
Yeah, and I would add one thing. I think Greg knows way more about this than I do, but my impression from everything I've seen is that you always have, historically the private industry has always said the government can't do anything right, and government always says that private industry is just thinking about itself, all these things. The truth is, from everything I've seen, is that the cooperation between government and business in terms of trying to minimize the threat of cyber problems, I think has been magnificent, basically, in that experience.
Yeah, excellent point. When it comes to cyber, the collaboration between a variety of U.S. agencies and our individual businesses, it's incredibly strong, including down to the certain agencies will submit basically a lot of our operating data on a daily basis, where they're helping us go through it to identify if we have a bad character, a bad individual who's maybe penetrated into our system. So it's a strong collaboration, and Warren, you're absolutely right. It's very unique to see how both the industry and the government's working so closely, but I think we both recognize it as such a significant risk. We have to stay strongly aligned on the approach.
It's a real partnership. It's a real partnership. And we can do better because the government is helping us, and the government can do better because we're helping them, and there's no lack of will on either side. And cyber, I mean, it blows your mind on sort of the nuclear is the number one threat, but it's a very, very, very low probability. Someday the sun will burn out too, but it is. There's really no place for two countries with large ICBM possibilities and who knows what else and everything, but we haven't figured that out yet. it's easy to go around and say this is a solution or that's a solution, but if you have two people with loaded guns facing each other, and
And not everybody is likely to be totally rational.
oh, well, we see so much irrationality in where people's self-interest is involved. They're doing all kinds of things to destroy themselves in terms of how they live their lives and everything. And it doesn't stop with as you move up the ladder. And some people do terrible things, and you just have to very much hope that they aren't in a position where they can do it all by themselves with the rest of the world as their supposed prize. Okay. If Station 3 will please ask something about motherhood and apple pie or something like that.
Okay. Dear Mr. Buffett and Mr. Munger, my name is Daphne. I'm from NYC, and this is my 5th annual shareholders meeting.
Well, we appreciate you coming. We do, sincerely.
As you know, for the past 4 consecutive months, we've been going through inflation with an inflation rate north of 7% for the first time since 1982. You both have experienced this before, from 1970 to 1975, at a time where your portfolio took paper losses, and yet you made some of the best investment choices of your life. Reflecting on that, my question is, if you had to pick one stock to bet on.
You kind of snuck up on us there for a second.
And be resilient in the inflation, which would you choose? And what specifically enables that stock to do very well and might very likely be a difficult market?
Well, I'll tell you something even better than that one stock. Maybe we'll get to one stock, but the best thing you can do is to be exceptionally good at something. If you're the best doctor in town, if you're the best lawyer in town, if you're the best whatever it may be, no matter whether people are paying you with $1 zillion or paying you, they're going to give you some of what they produce in exchange for what you deliver. And if you've got it, and if you're the one they pick out to do any particular activity, sing or play baseball or be their lawyer, whatever it may be, whatever abilities you have can't be taken away from you. They can't actually be inflated away from you. Somebody else will give you some of the wheat they produce or the cotton or whatever it may be, and they will trade you for the skill you have. So the best investment by far is anything that develops yourself. And it can't, not taxed, so that's what I would do.
I got some advice for you too. When you have your own retirement account and your friendly advisor suggests you put all the money into Bitcoin, just say no.
Yeah. Nobody can take away from you the talent you have. I mean, and the truth is that the world will always be willing. They'll need to do something, and some people will not have skills, and they will get less of the product of the society than somebody who has other skills. And sometimes that has something to do with education, but a good bit of the time it doesn't have anything to do with education. I mean, but to figure out what you'd like to be, and figure out how, and what you'd like to be is what you're going to likely be good at. And the world will we'll always need somebody on that tube to tell us what's going on. So, study Becky Quick or somebody and figure out, what makes her good, and what you sort of naturally bring to the game. I mean, I could have. Who's the guy that says you got to spend 10,000 hours doing this or that? And then Malcolm Gladwell. Malcolm Gladwell, would say just spend 10,000 hours on something. Well, I could have spent 10,000 hours trying to become a heavyweight boxer, but I don't think I'd have felt very good at the end of the 10,000 hours. I mean, you stumble in to what you really like doing, what you're good at, what is useful to society, and then it doesn't make any difference whether the dollar bill, is now worth, in terms of the purchasing power, a cent or a half a cent or a hundredth of a cent. If you're the best doctor in town, they'll bring you chickens, whatever they may do, but they can't take it away from you. And my guess is that if you've come to 5 meetings, you've got a very good future ahead of you. I mean, that shows it self-selects. I mean, if you want to sell a piece of yourself, that we'll buy that as the best investment we can make. We'll take 10% of your future earnings, and we'll give you a cash payment now, and we'll have a terrific asset. And you can have 100% of your future earnings, and if you make it, develop your talent, maybe you'll be a great dancer. People pay money to watch great dancers. We had Fred Astaire and his sister Adele that came from Omaha. Their name was Austerlitz then, but they could dance. And Adele did whatever she did with them, moved to England, and Fred Astaire went on to do a whole bunch of other things. And Ginger Rogers had to do it all the same backwards in high heels, and she didn't get paid as much because she was a woman. But you're going to do just fine. I bet a lot of money on you. Okay. Becky?
This question is for Warren and Ajit, and it comes from someone named Modi in Israel, who writes, "My family and I are long-term shareholders of Berkshire, and we plan to hold it forever. We like that the current management thinks in the long term to increase shareholder intrinsic value, but we aren't sure that at the time of the management change, the new management will act the same way you do. They might take risks in the insurance field where it's hard to find on the balance sheet, and that might take years to realize. We would like to know how we can assess the insurance risk today and in the future, or to know in time when you and Ajit are not here anymore."
Well, I would say that the future for a long time is about as assured as you can have in the world. We don't have an answer for the nuclear problem or anything, but we have a culture that A, has worked, B, has the shares and the shareholders that will carry it a long way. And the first year, let's say I die tomorrow, the first year, everybody says, what's going to happen? Are they going to spend it all? They're going to do all these things. You've got the shares held in a place that it can't happen. You've got a board of directors that understands that our culture is 99.9% of running the business. They don't think that having meetings of the committees and bringing in outside experts or anything like that mean a thing. I mean, it's a process that the world has adopted, and they've done it for reasons we understand. But Berkshire is just plain different. We are a business that exists for people that trust us. And all we have to do to fulfill that trust is fairly simple things. We've got the people to do it. We've got unbelievable resources to do it. And it isn't that difficult as long as you've got the freedom, essentially, to do it. And the world will write stories a year after, so a year later, what has happened at Berkshire. The railroad will be run the same way. The big worry, of course, is that somebody comes in that figures they can make billions as a group, or people that sell the businesses and say it's better to be private because, or it's better to be pure this or something like that. Well, we're a pure partnership. Is what we're pure at, and we do have what we think is a special relationship with our owners, and I don't think the relationship changes, and the ownership doesn't change that much. And the truth is, nobody can take us over for a long, long time. And by that point, we would hope that maybe the superiority of this culture might be somewhat better understood by the world, and we will be here. If we have the same culture, we'll be here 100 years from now, assuming we haven't had nuclear exchange or something. But Berkshire is built forever. There is no finish point. Nobody's waiting to retire or have their options vested or thinking about. We don't have anybody that's thinking about, should I take another job? It just doesn't. They're doing what they want to do in life, and it isn't because we're topping somebody else's offer, or that headhunters come around and say, we want this person or that person, and what will it take to get them? Well, they can't get them. I mean, now it's. I don't know whether we could build it again, but we've got it, and we didn't know we were building it exactly when we took over. When we had a lousy textile mill. I mean, it isn't like Charlie and I sat down. He didn't happen to be in Berkshire, but he was my partner and everything, and so we were mental partners. We didn't sit down and work out some plan that said, well, we'll run the dumb textile business for 20 years, and then we'll finally have to fold it, and then we'll do this and that and everything. We just kept putting one foot in front of the other, but we did know how we felt about running a public company. And one thing we wanted to do always was we wanted to have people that were in sync with us. We didn't really want that group I saw in the Flamingo, in 1952. We wanted people who trusted us. And we started, in my case, in a partnership. We started with 7. Charlie started a partnership. And this is the same thing. We didn't go to institutions, and we didn't pay fees to people to bring in money or anything like that. We sat down with people. In my case, I handed them a little sheet of paper, and it said the ground rules. And I wanted to be sure we were on the same page. I said, you don't have to read the partnership agreement. I mean, there's no way in the world I would be taking advantage of it. You shouldn't be here if you think I'd take. But I do want you to be on the same page and measuring me by the same yardsticks I measure myself. And those people stayed with me. And they're still, they're their children, their children's children, they're shareholders of Berkshire, but they're partners. And it'd be hard to do that again, but I would do it with whatever. If I were going to be in this field, I would try and do the same thing. I would try to find people that trusted me. And I don't want to be with people that are saying, how'd you do versus the S&P, last month, or, what's your long short position or anything like that. I sold securities for 3 years, and it just, I just didn't want to be in that position where essentially they thought maybe that I could do things that I couldn't do. So I finally found a way to get a few people. I mean, I didn't actually stumble into it, but a few people that trusted me, and they just gave me their money, and we've lived happily ever after. So it's the new management's got them. And the management after them, and the management after them, they're just, excuse me, they're just custodians of a culture that's embedded. The owners believe in it. People that work there believe in it. And we're not saying other things can't do better or anything of the sort. We're just saying this is what we've got. And we have got the directors, we've got the share ownership and all of that, and the size that essentially can ward off any attempts to change the culture. And it's silly to talk about if our board members did this and did that, and and in the end, obviously we're always going to follow the law, and we're a Delaware company, we follow Delaware law. But that doesn't mean that we have to do what every other Delaware corporation does and how they look at the Delaware statute. We'll follow the law, and then we'll run it as a group of people who trust us, and we appreciate that trust. Charlie?
Well, I remember when you had a textile mill,
God,
and
I tried to forget it.
the textiles aren't really just congealed electricity the way modern technology works. And the TVA rates were 60% lower than the rates in New England. It was an absolutely hopeless hand, and you had the sense to fold it.
25 years later.
Well, you didn't pour more money into it.
No, that's right.
And no, recognizing reality when it's really awful and taking appropriate action just involves often just the most elementary good sense. How in the hell can you run a textile mill in New England when your competitors are paying way lower power rates?
And I'll tell you another problem with it, too. I mean, the fellow that I put in to run it was a really good guy. And I mean, he was 100% honest with me in every way. He was a decent human being, and he knew textiles. And if he'd been a jerk, it would have been a lot easier. I would have probably thought differently about it. But we just stumbled along for a while, and then, we got lucky that Jack Ringwald decided to sell his insurance company, and we did this and that. But I even bought a second textile company in New Hampshire. I mean, I don't know how many, 7 or 8 years later. I mean, I'm going to talk some about dumb decisions. Maybe after lunch we'll do it a little. And it is incredible how many dumb decisions we made. Charlie and I bought that, and Sandy got us when we bought that department store, and that was 1966. And we were working with our own money, and why in the world did we think? And Charlie flew to Baltimore, and I mean, we used to really work in those days. and there again, we had wonderful people. Lewis Cohen couldn't have been a better guy, but everybody in that business had a different reference point. They wanted to expand their company. Well, who can blame them for that? And they were planning a couple of new stores, and each department, the shoe department, said, "Well, we'll do it better this time," and all that kind of thing. But the whole idea was crazy, and we got there for a little while, and we figured it out finally, and
we reversed course.
Yeah, but why the hell did we do it in the first place?
Well, because we were stupid.
Yeah. Okay. Well. That's important to realize. We paid $6 a share for that stock, and if the department store has succeeded, it might be worth $30 a share now, and it failed. So, but we did other things, and we merged it into Berkshire, and we'll talk about that a little later. And I don't know whether it's $150,000 a share now or something like that from the $6. So if it succeeded, we would have maybe made a few dollars, and because it failed, we made hundreds of thousands of dollars per share. But that's the way life is. You just keep going, and
keep learning. That's the secret.
Keep learning.
Keep learning.
Keep learning. And you can say, why would it take guys that long to learn? And well, we got a few minutes before lunch, let's address that problem, because I did bring something along on that. There have been, well, I started buying stocks when I was 11. I've been reading every book in the library on it. I loved it. My dad, it was his business, and I'd get to go down to his office and I'd read the books down there, and I saved the money, and finally, by the time I was 11, I could buy a stock, and I could tell you at that time, I went to New York Stock Exchange when I was 9. My dad took us to New York, each kid to New York once, and he took me. I went to New York Stock Exchange, and I was in awe of it. I could tell you how the specialist system worked and the odd lot arrangements, and I could tell you history of finance and all of these things. And then I got very interested in technical analysis and charted stocks, and did all kinds of crazy things, hours and hours and hours, and saved money to buy other stocks, and tried shorting, and I just did everything. And then when I was either 19 or 20, and I can't remember exactly where I did it or something, I picked up a book someplace. It wasn't a textbook at school, but it was in Lincoln, Nebraska. And I looked at this book, and I saw one paragraph, and it told me I'd been doing everything wrong. I just had the whole approach wrong. I thought I was in the business of trying to pick stocks that would go up. And in one paragraph, I saw that was totally foolish, and I left. I brought something that it's really interesting. Let's put up. What do we call this chart? Don't think we. Oh, here we are. Yeah. Let's put up illusion 1. Done. Yeah, there we have it. Now if you look at that, some people will see two faces. Some people will see a base. And some people will look a long time and only see two faces. But the mind flips from one side to another. And that's, there's some name for it that they call it ambiguous illusions or something of the sort. There's other things that talk about aha moments, or in the old comic strips with Popeye, Wimpy would have a little balloon over his head and the light bulb would go on. There's this point where all of a sudden you see something you haven't seen. Well, it took me, I had an illusion that I was looking at, we'll say in that one, two phases. Let's go to the one labeled 2. And if you're looking at it from one side, it looks like a rabbit, and if you look the other way, it looks like you're looking at a duck. And the mind is a very funny place, and I think people call it an apperceptive mass when you have all kinds of things going on in your mind, and they go on for years, and they sit there and get lost, and then all of a sudden you see something different than what you were seeing before. Now, and it took me in stocks, which I was intensely interested in. I had a decent IQ, and I was reading and thinking, and it was important to me to make some money on it. I had every motivation in the world. And then I read a paragraph, actually, in chapter 8, I think it was, of The Intelligent Investor. And it told me that I wasn't looking at the duck, I was looking, now it was the rabbit, whatever it may be. And whether you call it a light bulb, whether you call it, a moment of truth, whatever it may be. And that's happened that happened to me in Lincoln. I mean, it changed my life. If I hadn't read that book, I don't know how long I would have gone on looking for head and shoulders formations and 200-day moving averages and the odd-lot ratios and a zillion things. And I love that kind of stuff, except it was the wrong stuff I was looking at. And I've had that happen, and Charlie's had it happen, I'm sure. It happens a few times in your life. And all of a sudden, you see something important that, why in the hell didn't I see this in the first place? Maybe it's a week ago, maybe it's a year ago, maybe it's 5 years ago, maybe it's learning how to get along with people. You know, I mean, whether actually it's better to be, you know, kind or not, you know, or whether, I mean, they're just learning how to have, if you want the world to love you, what you have to do, or what, it's, you know it when you see it, but you didn't see it for 10 years before. And I don't know whether Charlie's got some thoughts on that or not, but that's happened in a few situations in business where I've looked at a company for a decade, and then there's something that it just all gets rearranged in your mind, and you know, you can say, well, why didn't I see this 5 years ago? But usually, I've had it happen a few times, obviously, and everybody here has, and just in different areas of their lives. And you think, how could I have been so stupid? Well, that's what Charlie's, when he was in the law practice, he had a partner, Roy Tolles, and every smart guy that would get in trouble, usually it was guys, and usually it was with women, and you know, they'd come into the office and they'd look, you know, down-faced and everything, and they'd say it seemed like a good idea at the time, you know. I mean, and their lives unraveled, you know, in many cases. So there is that apperceptive mass that's sitting in there inside somehow, and every now and then it produces some insight. It's better, actually, if it produces insight into your behavior than whether it produces insight to make money. I mean, and some people never get it, and they wonder why they're, you know, whether their kids hate them or whether there's nobody in the world that would give a damn whether they live or die. In fact, they prefer they die because then they've been courting them for their art collection or whatever it may be. It just, Charlie would say, you know, just write your obituary and reverse engineer it, and not a crazy idea. Charlie, I don't know, what do you know about apperceptive masses, which are optical illusions?
Well, I know that that's the way the brain works, and that it's easy to get it wrong. And part of the trick is to get so you correct your own mistakes. And we've done a lot of that.
Yeah.
Frequently way too late.
Yeah, we've done better with the mistakes than we have with the reasonably good ideas.
Well, it's so easy to overdo a good idea. That's what's going on now. You have a lot of good ideas that are being grossly overdone.
Well, just tell me about one that hasn't been, but tell me later when the crowd isn't listening. That's where.
Well, look what happened to Robin Hood, from its peak to its trough. Wasn't that pretty obvious that something like that was going to happen?
Tell me again what it should have
Robin Hood, when it came out and it went public and
Oh.
it got lured everybody in all the short-term gambling and big commissions and hidden kickbacks and so on and so on. It was disgusting.
Yeah. And it says so last year, and they got mad at you, and they sold a bunch of their stock, and they got the money, and
Yeah, but now it's unraveling.
Yeah.
God is getting just.
but a lot of the insiders have they've gotten a lot of money from it. I mean, they were big sellers, as I remember.
That may be, but
Yeah.
there's been some justice.
Well, I have to agree with that. Well, it's a good idea to go around making enemies of people, though. another question, which we do. Is it wise to criticize people at all?
Probably not, but I can't help it.
Yeah, well, and here's the smartest guy I know, and he's 98 and he hasn't figured it out yet. So, I mean, give up. Enjoy. Well, with that, we'll go to lunch, and we'll try to come back wiser at 1 o'clock. And thank you, thank you, thank you. Okay, let's reconvene. I think we sold 15 boats so far. I was told that a little while ago out there, so get them while they last. We won't have the first one available for delivery for about a year, but people are getting 10% off, whatever that means, who order one, and I've ordered one myself, and things are going well in the other room, and we only got 7 questions, which is the new low in the first half, so we'll try and move a little faster. I can't imagine why it went that slowly. I mean, who's doing all that talking? Okay. Station 4.
Hi, Warren and Charlie. I'm Jeff Malloy, shareholder from San Francisco. In recent years, American companies have taken on a more active role in the political realm, whether it is speaking out against specific bills or promoting various social causes, often at the behest of shareholder or employee groups. While the goals of these movements can be laudable, they risk alienating significant portions of customer and employee bases. How should CEOs decide which issues to take a stand on, or whether their companies should engage in the political realm at all? Thank you.
That's a terrific question. And that is one, obviously, I've had to think about plenty. And at one point, I said, I don't put my citizenship in a blind trust when I take the job as CEO of Berkshire. But I've also learned that you can make a whole lot more people sustainably mad than you can make temporarily happy by speaking on any subject. And on certain subjects, they will take it out on our companies. And that means that the people that are employed by us, some of them we would end up letting go. It means that the shareholders get hurt. And do I really think that it's so important that I talk on every possible subject that people can get very upset about, whether they should be asked to pay that price? And I've come to the conclusion the answer is no. Why in the world do I want to hurt the people in that other room that do all kinds of things for Berkshire? Why do I want to hurt you because I say something that 20% of the country is going to instantly disagree with, and sometimes they will be so upset about it that they will try and take it out. And since they can't scream at me, they may have campaigns against their companies or anything else. So I think it applies to me. I'm not going to go around and take positions where instead of saying Warren Buffett says, it will say, Berkshire Hathaway or Warren Buffett of Berkshire Hathaway. I get it identified, and I do not want to make the lives of you and I just decided I'm not going to be doing that. And if I want to do that, I should quit my job. And if I think my citizenship, speaking out is that important, I'll give up what I love the most, which is having this job. I don't want to do that. So I've decidedly backed off. I don't want to say anything that will get attributed basically to Berkshire and have somebody else bear the consequences of what I talk about. And so that's where I stand. And I can tell you that at most companies, or many, that isn't fair, but in a great many companies, the CEOs, they have to think about what their board says to them, and they've made a point of electing people to their boards because it's socially acceptable, who represent different constituencies, sometimes very strongly. And if they think they're stakeholders for this group and that group and that group, they'll get pressured by their boards to take positions, and it's just a territory that we're not going to get into. Charlie, how do you feel about that?
Well, even more than you, I have to be very careful about what I say.
Now, and the difference between the two of us is I can't resist saying a little more. I see headlines in papers just time after time after time that say, Buffett's buying such and such. Well, I'm not buying such and such. Berkshire Hathaway is buying it, and it may be the work of two other people that work at Berkshire. And the people who write the articles don't have the faintest idea whether it was at my instigation or whether I'd even ever heard of it. And but the headline will attract more people if it says Buffett buying this than if it says Berkshire Hathaway, and we don't know whether it's the people that work for him or him. And the headline is designed to bring people into the story. So the confusion is terrible. And the easiest thing to do is to basically shut up and not have a bunch of people facing consequences that they didn't ask for in the first place. So with that, but I'm glad you asked that question. That is a good question, and I probably thought more about that question than I think about whether this stock or that stock is cheap. And with that, we'll go to, let's see, that was station 4. We'll go back to Becky.
On that note, let's go to a question from David Cass. He writes in, President Biden's fiscal 2023 budget request would impose a 20% minimum tax on the unrealized capital gains for households worth at least $100 million. What are your views on this issue? And if you don't want to answer, maybe Charlie does.
Well, we'll find out. And we should, in all honesty, we should both say that we would be affected by it. If it's 100 million, we'd both be affected. So our point of view is, and I have no point of view. Charlie, I have no point of view that I would want attributed to.
I tend to stay out of the income tax things like this. My policy is I pay whatever taxes they pass, and I don't want to engage in lobbying about taxes.
Yeah, and I would add one thing. Lobbying is really distasteful. I once did it for a candidate, and I ended up in a room with a bunch of lobbyists for cigarette companies. They didn't care about Nebraska. They didn't care about it. They didn't have anything. They were there because they were handing over a contribution. They didn't, and I was a convenient accessory, and it made you want to throw up, basically. On the other hand, we operate in the railroad business, energy business, insurance business, and there extensively regulated. And I don't also want to be the only railroad that stays out of the railroad group, the only insurance company that stays out of the insurance group. So, other people can rightly figure that we're a free rider under those circumstances. So I tell the managers generally, don't spend Berkshire's money on candidates that you like. Don't pressure suppliers to do it. I mean, Berkshire is not a weapon to use, and it's been used by certain people in the organization, but don't use it to muscle money out of anybody else for who you like or what school your wife went to or whatever it may be. And some of it goes on anyway. But I don't tell our people that don't belong to any trade associations. Charlie wrote one of the great letters of all time. And if you go to search, type in, I think, 1989, Munger savings and loan or something. We resigned from the U.S. Savings and Loan League, I guess it was, and we warned them. We said, we just cannot stand what you're doing to the country. And what a bunch of very nice people get together, but they decide it's in the interest of their savings and loan to do this or that. And we warned them, and finally Charlie wrote a letter, which is, like I say, available on search. And it's should be one of the proudest letters, certainly one of the proudest letters that's ever come out of Berkshire. And he just said, we can't stand it anymore, and we're resigning. And but that's a very tough thing to do. You can't. It's a tough way to live, to just go around criticizing the people you work with and the neighbors, and they're perfectly decent people, but they run into institutions that are doing things that are very distasteful to them, and we support some of our subsidiaries in energy, and I don't want to find people who are doing it for personal reasons. I mean, in that case, they're in trouble. But I don't say they can't do it, because I don't want their hands tied if something comes up. And essentially, either they're competitors within the industry or the industry versus this. We're not going to stand alone and say, well, we're morally superior to us, so you put your money up and fight it. So that's where I end up. Charlie?
I've got nothing to add.
Okay. It never bothers me when I don't have anything to add, but he seems stuck on that. Anyway, Becky, did that come from you?
It did.
Yeah, okay. Then station 5.
Oh, thank you, Warren and Charlie. My name is Tong Yao. I'm from China and now studying in the University of Chicago. I really admire you two, especially Charlie. You are my idol since I was a child. And my question is also for Charlie. My question is how to practice the multidisciplinary framework in making investment decisions and in life. Like how to make it more practical. Thank you.
Charlie?
Well, obviously, it helps you to know more than one discipline. There's an old saying, that a man who carries only a hammer thinks everything else is a nail. And you make a lot of wrong decisions if you don't have some command of all the disciplines. That's all I ever said. But you do irritate people terribly when you come into their territory. You say, I'm multidisciplinary, you're the expert, and I know better than you. They hate you for it. I can attest to it. I've done it several times.
Yeah, and China, well, to a certain degree, they have a culture that to some extent reveres age So Charlie's got me beat. I don't even try and compete with him on China. I can't catch him on age. Okay. I'm going to try to, though. Let's see, we've got Becky coming next.
This question comes from Philip King. He writes, in the 70s, you wrote an article entitled, How Inflation Swindles the Equity Investor. You said that stocks cannot keep pace with inflation because companies cannot increase the return on equity. Do you believe that this is still the case?
Yeah, and of course, bonds can swindle the equity investor too. Everything, inflation, I should say, swindles the bond investor too. And it swindles the person who keeps their cash under their mattress. It swindles almost everybody. And the problem, if you have a business that doesn't take any capital, and let's just say the dollar depreciates 90% or something, so things cost 10 times as much. If it doesn't take any capital, you can charge 10 times as much, and you've kept your relative position. But most businesses take some capital. If our utility business, if just say that the dollar is worth 1/10 some years hence from now, we have to have 10 times the capital investment, basically. And we get paid a return on that. But we have forced capital investment to essentially keep them in the same place. And I wrote an article that related to that, and I will tell you one famous story which you will all sympathize with, and that I wrote that story for Fortune, and when I finished it, it was about 7,000 words. And Fortune didn't like publishing 7,000 words, and they had my friend Carol Loomis explain that to me, knowing that I would pay more attention to her than anybody else, but being stubborn and male, I said, every word is precious, and they can either run it or not. So then they sent an editor, a very nice guy, out to Omaha, and this guy explained to me that just wasn't right to use that many words. And I said, well, that's fine, but if you don't do it, I'll write it someplace else or something. Very disgusting behavior on my part. And then I sent it. It was beginning to bother me a little. So I sent it to my friend Meg Greenfield. And Meg was a great, great, great editor at the Washington Post. And we were very, very good friends. Wonderful woman. And Meg, who was tough as nails with most writers, but she was kind of nice. She didn't want to really hurt me too much. So I said, well, Meg, what do you think? And she said, well, Warren, she says, you don't have to tell everything you know in this article. And it made the point. And so I write that article shorter, but I'd say more or less the same thing. No, you're better off if you really could have a totally stable unit of monetary use for the next 100 years. It would be better for business and investors in general. Charlie? No? We will go to Station 6. Inflation is, the question is how much, and the question is whether you can decide that 2% and keep it. The answer is nobody knows. You do not know, and nobody knows. You can listen to all kinds of stuff, but nobody knows how much inflation there will be over the next 10 years or 20 years or 50 years or next month. And people talk about it all the time because you're interested in knowing the answer to your question. And they don't know the answer, but there are a lot of people that will tell you they know the answer if you pay them enough, and other people that will tell you for nothing because they think it enhances their prestige and makes them more valuable and all that. But the answer is they don't know, and we don't know either. The best protection against inflation, though, still is your own personal earning power. If you play the violin very well, you will do reasonably well during inflation. I mean, play it better than other people. People will pay you for doing that if you know, all kinds of things. So your skills will not be taken away, and your money may be. Okay, station 6. Oh, wait a second. Was that?
That's right.
Is it Becky next? Becky?
That's right. It's station 6.
Yeah, station 6, okay.
My name is Martin Wiegand. I live in Nashville, Tennessee. Mr. Buffett and Mr. Munger, thank you for your lifetime of teachings and for hosting us back in Omaha this year.
Well, thank you.
You have mentioned that companies get the shareholders they deserve. And in this year's letter, you mentioned a great satisfaction of yours is working for the individual long-term shareholders. With the growing influence of institutional index funds, how can management teams foster a shareholder culture like the one we have at Berkshire? Thank you.
Well, fortunately, we have it. And we know more about how to keep it than to institute one. And it's very interesting. We have 1,470,000 Class A shares outstanding today. That's fewer than we had a year ago in there. Those seats are filled. I mean, the shareholders are in place. We like the group we have. So why in the world, when we got a fixed number of seats, should we go out and recruit other people to replace you? I mean, the ideal shareholder group we can have is the group we have today. And why, if we had a church, we'd want the people to keep coming back week after week after week. If we had a limited number of seats and we had some wonderful parishioners, and we would not go out and recruit another 50 or 100 of them and have to throw out 50 or 100 of the ones we already had. Every company I know virtually, is wooing new people to come in, and whether they're improving the group they get or not is another. I mean, it strikes us as basically crazy. We don't want anybody different than we have now, and we're not going to get rid of the index funds, so we have to get rid of people like you, and we don't want to get rid of people like you. And I just don't understand why if you had a neighborhood and the size of the terrain or whatever it was would be such that you could have 10 neighbors and they were all great neighbors, why in the world would you go out and say to a whole bunch of people going up and down the street, why don't you buy the house of the guy next to me? It is weird, but there's an awful lot of people who make their living by doing that, and they never really question. I would sort of ask any company that's making analyst presentations every month or something, which of the present ones are you trying to get rid of? Basically, because you're not going to have more. I hope you're not going to have more shares outstanding at the end of the year than you have now. And am I supposed to, get out of the way so some other fund that is thinking about what your stock is going to do next week replaces me? It is a very, very, very weird situation. And of course, the really crazy process that has developed is people talking to, we'll say, analyst group, the sort of the high priests of finance. Some companies are doing it more than once a month. Well, just imagine if you work for that company, you go to work for that company, and every month people are repeating these things about their company, that it's important that we have more services per customer, and it's 6.2, and we got to get to 7 or something like that. And they'd say that month after month after month. It becomes a catechism. And CEO says it, or his or her representative says it, and it goes, how do you go on the next month and say, by the way, we were really wrong, and this is what we should be working on? You don't say that. And it's a terrible problem that the new CEO has, coming in after a previous CEO has said the important thing to do is to hit your earnings targets. Well, you know, he's been meeting them in all probability by cheating from some time to time. And this guy hands you the baton, and are you going to come out and say, well, we've really been cheating a little, and it's really counterproductive to the development of the companies, not to make earnings projections and just to give you the results as they come, rather than making up a few things in the accounting department? They can't do it. You can't. It's not human nature. And besides, you wouldn't get appointed as a successor, but you just don't go in and say, we've been perpetuating these myths that we can always deliver 8% growth, or we can do this or do that, or that the most important thing is this. You can't go in and change that if every month you've been preaching to people that this is what we stand for, and just ask another question and carry this message out to the masses, to the analysts and all that. And it's a totally destructive policy. I mean, I can, within GAAP accounting, and I can play a lot of games with numbers. We've done a lot of dumb things at Berkshire. We have never told anybody that the number had to be this or that, or to change anything. I mean, it just, once you start it, it's all over. You can't quit. It's like taking $5 out of the cash register. The first time you take the $5 out, you say, well, I'm going to put it back. And then do it a few times, and you'll never stop. In fact, do it once, and you probably never stop. But it's if something is going to be destructive, the thing to do is not start it. And forecasting earnings, I can't imagine anything more destructive. I got 360,000 people out there, and they know whether I'm lying or not, a good many of them. And they know if they send in figures and they get changed, what message are you telling them? We've got one dramatic illustration of that within Berkshire, and it's just, we want to. If you start lying, you got a big problem. It's that simple. And if you start saying to your team that somehow you've got a job, you've got shareholder relations, your job is to go out and tell everybody that our stock is the best thing among thousands of choices to buy every day. Well, that's crazy. And so what do you tell them? Well, they try to see which way the wind is blowing and figure out what they have to tell people, and then they go out and tell them. And then if you're a human and you said we're going to earn $3.59 a share, you can get to $3.59. You can get there quite a while. And you can have audit committee, you have all these processes. But if you have a culture of lying, the processes really don't. They just disappear. And Charlie and I have seen it, well, every time we've gone on a board. But, Charlie, tell them about it.
Well, I think Berkshire's culture is going to last a long time after we're gone. And I think it should, and I think it'll prosper pretty well. The rest of corporate America is quite different. And it gets more different, I think, with each passing decade. And it's getting very peculiar. Pretty soon they're going to hold all the shareholders meetings online, and the shareholders won't even come. And it's getting very peculiar, and the index funds get more and more important in the voting. And it's like everything else in life. It changes, and not always in ways you like.
And it ends up for selecting different CEOs and all kinds of things. I mean, you're not going to appoint a successor CEO that's going to come in and said everything that's been done before is, it's been kind of fraudulent. I mean, if we needed to book an extra sale after the end of the quarter, if we needed to adjust the reserves, and it's once you start lying, it's all over. And I just don't know any way around that except to try every way you can to not. You sure can't. If you set the wrong example at the top, you got a real problem. We've never told anybody to change a figure. We never will. And if they had been changing figures, we'd be in all kinds of trouble because they know it and I know it and the next person would know it, and it just deteriorates. And we've really seen it. We've really seen it time after time. The way boards operate, it has to be process oriented. I mean, I understand the problems that Delaware has in writing a statute that judges face when they look at things, but it's extraordinary. It's just extraordinary what an emphasis on process can do to an organization because they think they can do anything if it's allowed, and eventually the foundation crumbles. Okay. Oh, I should make a little news here. So, you've all come, and you may or may not see this, but it's very possible. One of the things I bought, it was bought for a different purpose by a different manager months earlier. He bought roughly 15 million shares of Activision. And I never paid, I knew about the company, but I would just see it at the monthly report. But then on January, 17th or 18th, something like that, Microsoft announced they were going to buy Activision for $95 a share. Now, when they announced that, at that point, Activision becomes a different kind of security. It becomes what Charlie and I used to call, everybody did, 50 years ago, we'd call them workouts or something like that, and they become known as arbitrage. Well, they're not really arbitrage, but they're securities, they're, in this case, a common stock, whose value depends not on what the market price does, but whether a given corporate event occurs, an announced corporate event occurs. Well, Microsoft wants to buy Activision, we'll say. Well, they said at $95 a share. And they've got the money. And obviously, mergers and big mergers, tech companies, all kinds of things, have got all kinds of problems with the world generally in terms of opinion. So you don't know what the Justice Department will do, or you don't know what the EU will do, and all kinds of things. But at that point, it becomes a different security. And Charlie and I, 50 years ago, we used to do a lot of that sort of thing. And Gus Levy did it at Goldman Sachs, and we even went back one time, I think, on British Columbia Power, didn't we, Charlie?
Yeah, we certainly did.
Yeah. A guy named Bennett was up there, and we were trying to figure out whether some takeover of the power business. I mean, we spent a lot of time analyzing the probabilities of announced deals going through, and we call them workouts. Now the term became ARB, and it hasn't worked overall too well in recent years. Now, every now and then, I see something that I want to do in that field, but very seldom, because they got to be big. The profit is limited. If they say you're going to get 95, you're not going to get 96, and if the deal blows up, you may have a stock that's at 40 or something. So but we did it with Monsanto 5 or 6 years ago when Bayer was buying it, and we got very lucky because it turned out to be a terrible acquisition for Bayer, but it did go through because Bayer had the money, and they went through with the deal, even though Monsanto came with a problem that nobody really understands the extent of. And we did it with Red Hat when IBM bought it. So, in any event, on January, whatever it was, 17th, 18th, 19th, Microsoft announces it, and the stock, which had been at 60, let's see I may have a slide here, which I'll find, but in any event, the stock, which had been in the 60s, went up to the 81 or 2, and that looked like not a big enough spread to me for a few days. And then it settled back a little. So anyway, we now own 9.5%, something like 9.5% of Activision. And if we went over 10%, we would file a report. So in order that the news people don't feel that there's no news there, I can tell you that as of yesterday, we own about 9.5%. If we go past 10%, there'll be a form filed with the SEC and so on. But it is my purchases, not the manager who bought it some months ago. If the deal goes through, we make some money, and if the deal doesn't go through, who knows what happens. But I just want to be sure that if we do file that report, people understand very clearly, because there's been some very mixed up stories on that in the past. We want to be very clear that it was Warren Buffett's decision in that particular case, and he doesn't know what the Justice Department's going to do. He doesn't know what the EU is going to do. He's never talked to anybody in Microsoft about it or anything. He's just read a document. He's made his own assessment, and it can change. And at one time, I think we sold a few shares even when I thought it was a little higher than it should be. It turned out those sales were not bad sales. So I just want to create a little news for you, and I want to, if possible, head off stories which have been incorrect in the past, and which then get picked up by other media, and corrections never get written. That all the corrections were written by one inaccurate story, and they apologized even to me. Both the reporter and the editor sent me a personal note of apology. They didn't expect to make a mistake, but when the other publications picked up the story, they didn't bother to pick up the correction, and millions of people were misinformed, and probably literally by the time it gets spread around. This one I will attempt to head off by telling you exactly what the facts are right now, and we'll see whether we go beyond 10%. But if, it could easily be that if it went up a few dollars, it's still a $95 deal. It's still, we don't know what the Justice Department will do. We don't know what the EU will do. We don't know what 30 other jurisdictions will do. One thing we do know is Microsoft has the money, so that takes that one risk out of it. So anyway, Charlie, do you have any news to break?
No.
Yeah, and incidentally, I don't talk this over with Charlie. I mean, he knows what that occasionally I'll see an arbitrage deal and do it, and 50 years ago we were doing it together, and his general feeling is, why is Warren fooling around with this kind of stuff even? But It's the old fire horse, but occasionally it looks like the odds are in our favor. But absolutely, we can lose money on that company, and fairly large sums of money, depending on what happened if the deal blows up. And there will be a lot of people that want the deal to blow up. But Microsoft doesn't want it to blow up, so we'll have to see what happens. Okay. Enough. Becky.
Charlie just mentioned index funds in passing, so let's go to this question from Matt Feigl. His question is related to the growth of passive investing through index funds and ETFs. He says, passive investment vehicles now control upwards of 50% of the United States stock market. The actual owners of these passive investment vehicles decided passive investing makes the most sense for them. Yet in doing so, passive investors have empowered the large index funds to become the biggest activists in the market. These passive managers now enjoy enormous, and I would argue undue, influence over corporate governance. Do Warren or Charlie see any benefit or logic to a rule that would prohibit passive investment vehicle managers from voting the shares they control for their passive investment clients?
Well, I'll take that. I think the guy's right. I think the thing is out of control and counterproductive. And I don't think it's good for the country to have 3 passive investors with bright young men from Harvard or what else telling them what proper governance of corporations is. It's not a good development. And it is, and I think indexing, if it gets to 90%, then it won't work very well at all. But at the moment, it's worked fine.
Yeah, well, the one thing you can count on, too, is that if it does look like it's going to, if the public opinion shifts over to the idea that it really isn't a good idea to let 3 people decide the fate of every company in corporate America, the 3 people, and they won't collaborate or do anything. They're evil people in the least. I mean, they're just doing what you and I would do. They would figure, we don't care that much about voting. What we do care about is keeping a lot of assets under management. So we'll figure out something that ends up reflecting public opinion, and then politicians won't get mad at us. And our only threat really is that politicians get mad at us and regulate us in some ways. So we'll head it off. And I would predict fairly confidently that if the American public doesn't like the idea of 3 people controlling things, the 3 people and their organizations and everything, but what they want to do is they want to get bigger. And they wouldn't be where they are in life if they hadn't wanted to get bigger. Those things don't happen by accident. That doesn't mean it's the only thing they want. They want their investors to get good results and everything. But they are certainly not going to follow a policy which is going to cause a backlash that causes them to be a lot smaller then. They can figure out their self-interest. I mean, and it just so happens that in this case, it would achieve the right result, which is that they would not control America, but they'll do what's good for themselves, and what they have to do, what's politically acceptable. The only thing that really can mess up what is a very good deal for them is to have Congress change the rules. And the rules were the Investment Company Act of 1940 really changed how people behaved, and it's governed things in a big way for a very long time. And anybody that takes on the federal government loses. And if you're talking about trying to do that sort of thing, and they don't need to do it. They just say, well, we'll give up voting, or we'll vote our shares as the rest of people do. And of course, if you vote your shares as the rest of the people do, then if the index funds had 90% of the country, you could take over a company by somebody else buying 3 or 4% because you'd automatically get the funds to follow your very small little percentage, you'll see it all play out. I mean, it's a big case, but it's not an unusual case. Okay, station 7.
Yeah, Eric Erda, and I live in Albuquerque, New Mexico. So I want to first say thank you so much for a lifetime of knowledge you have both graciously shared with all of us. You've contributed greatly to push our species forward. Moreover, you've taught all of us here, along with many, many millions not here, how to behave more rationally, treat one another with more love, and lead more fulfilling lives. And for that, I want to say a very sincere thank you.
Thank you.
As for my question, I want to ask about Berkshire Hathaway Energy and the unique structure that has evolved there, given that Berkshire doesn't own 100% of the company. The first part of that question is related to Greg's ownership and his corresponding incentive alignment with overall Berkshire. Now, there's a wise man named Charlie that in 1995, at a speech to Harvard, taught us how important incentives are to human behavior. I would conservatively say that Greg's stake in BHE is worth more than $500 million at present. And I'm curious if you can share any plans that you have to convert his Berkshire Hathaway energy ownership to Berkshire stock. And if there isn't a plan to do this, can you please explain why we shouldn't be concerned about Greg's incentive structure going forward? The second part is about leverage at the entity. You have always said that BHE operates with an appropriate amount of leverage given its earning power. With that said, it's still a very, very large debt figure in relation to current earnings, especially with what we have become accustomed to at Berkshire. And I'm curious, if Berkshire owned 100% of Berkshire Hathaway Energy, would you still operate the business with the same amount of leverage?
Okay, thank you. The second part is the easiest one to answer, so I'll take that. And I'll throw the first one back to Charlie. But the Berkshire Hathaway Energy actually is required with its regulated utilities, and it basically started pretty much with regulated utilities, and still is dominated by that, and we're interested in buying more regulated utilities. It's required in different ways by different states and by different regulatory authorities to have a large amount of debt, because the regulatory authorities will say, in Iowa or to pick any state, the regulatory authorities are going to say you can get debt money cheaper than you can get equity money, which historically has largely been, almost always been true. And they say that since we're going to allow you a return on equity, we'll say, just pick a figure, but let's say they allow us a return on equity of 9%, and we can borrow a lot of capital at 3%, they say it'll result in higher rates to customers if you use it, put in all equity. We would love to have all equity in our utilities, but we wouldn't, the regulator wouldn't stand for it, because it would result in, under the traditional system, it would result in higher prices to consumers. So that's built into the system. And our regulator wouldn't allow us essentially to get the same return on equity and have an all equity structure. The answer is, we put, well, you actually saw in the film earlier, which the people that are listening or hearing the webcast didn't see, but just in Iowa, we recently got approval to spend $3 and a fraction billion, but they want us. Iowa has a history in, like every other state in the union, except Nebraska, which is all public power. But every private power, they have a history of wanting X percent to be in debt. They want you to raise a lot of money in debt because it's cheaper, means cheaper power for the consumer. So the answer is if we owned 100% of Berkshire Energy, we would absolutely be following the same. We would be operating pursuant to what the utility commissions tell us they want us to do. That they represent the people of those states. Now, Charlie, do you want?
Well, the other one's simple too. It's an historical accident. It's not causing any big tension or breaches of fiduciary duty. We had the same problem with Walter Scott, who was the director for years and years, and owned stock in the same company, also an historical accident. I just don't think it's a big problem at all. I see no behavior from Greg ever that isn't in the best interest of Berkshire.
Yeah. And we've had various percentages of Berkshire Hathaway Energy ever since we bought it in around 2000. And it happened, we were at my sister who's here, we were at her house and there was a party going on and 20 or 30, probably 30 people. And Walter said to me, if you got a minute or two, I'd like to talk to you about something. So we went in the library or someplace, and Walter says, we've got this company and it doesn't seem to fit the public mold very well, and would you want to buy in and go private? And I said, sure. Depends on the price. And when we got back to Omaha, I was out on the West Coast, we got back to Omaha, and we met with David Sokol, who was the big holder, aside from Walter. And we agreed on a price. And I remember Walter saying to Dave, don't negotiate with Warren. He'll tell you to forget it and he'll do something else. And so we bought it. And so it was kind of a weird structure from the start. And we had a public utility holding company act to deal with and all kinds of things. And it's evolved. And it now has us with 91% roughly, and it has Walter's estate, and I don't know where that goes at all. And Walter never talked to me about it, and I never asked him about it. But it's one way or another interest connected with him, or in the estate now, close to 8, I guess. And Greg's got 1, and the from our standpoint, if we made a deal with if they ever came to us and the Scott interest wanted to do something, we'd say fine, and we'll do the same thing with Greg if he wants to, and he probably would want to. But from our standpoint, I've never seen any decision remotely. If I thought that would make a difference, he would not be. He just wouldn't be the right kind of person to run Berkshire. And the problem, of course, is that you've got lots of process that can be involved with insiders and everything. And I've got no interest in, as long as I'm alive, my interests are 100% with Berkshire. And the board wouldn't probably, and to some extent, a little reluctantly, but they just say, well, if Warren thinks the deal's okay, it must be okay, which is true. And so I could make a deal with anybody and it doesn't get all messed up with process. But on the other hand, if I'm not around, the pressures are the directors to do whatever the lawyers tell them to do, and the lawyers tell them to do this and that, and then they want to bring in investment bankers to make a value. And the whole thing is a game from that point forward. And it's expensive. It takes a lot of time. So it would be better if it happened while I'm alive and around. But there's no reason. We'd rather have 100% than 91%, obviously, because more earnings for Berkshire. But there's no reason to try and do anything with either the Scott interests or Greg, unless they want to do it. And the logical thing is if anything happened with the Scotts, we'd certainly offer it to Greg. But who knows what happens in the future. The one thing I guarantee you, Berkshire Hathaway holders will never be taken advantage of, and you can sue my estate or something like that if anybody felt differently about that. It isn't going to happen. But it's a lot easier if it's done while I'm around, actually, than if it's done later. But
I wish we had 20 more conflicts of interest just like it.
Yeah, that's exactly true. Yeah, it's a perfectly logical question. I mean, but it is not a problem, and any answer that's arrived at will be good for all concerned. And right now, I've got no feeling that I have no knowledge at all of where the stock that the Scotts have goes, or how they feel about it, or anything. And that's up to them. The Walter was our partner, and as far as we're concerned, we treat anybody connected with them as our partner, and they know that. They don't have to worry about us taking advantage of them, and we can understand if they don't do anything, we can understand that. If they want to do something, we can understand that. It's a good question, though. Thank you. Okay, Becky.
This question comes from Steve Blackmore in Bozeman, Montana. This is to Charlie. He says, in the past, you've made favorable statements about investing in China, in part based upon valuation metrics. What is your opinion now, and how much weight do you put on the actions of the government in your analysis? Do the recent Communist Party activities in China, including human rights violations, blatant cyber theft from U.S. companies and others, crackdowns on speech from business and media, etc., cause you to change your opinion on investing in China? And how do you evaluate the clear dangers of investing under authoritarian regimes, as recently evidenced by Russian atrocities in Ukraine?
Well, those are good questions, and there's no question about the fact that the government of China has worried the investors from the United States who invest in China more in recent months and years than he did in earlier periods. So there's been some tension, and it's affected the prices of some of the Chinese stocks, particularly internet stocks. Just in the last day or two, the Chinese leader has sort of reversed course on that and said he went too far and he's going to pull way back, and so on and so on. So we're having some hopeful signs. But yes, there are more difficulties of dealing with the regime in China than there are in the United States. And it's different. It's a long way away, and they have their own culture and their own loyalties, and so on and so on. And the reason that I invested in China is I could get so much better companies at so much lower prices, and I was willing to take a little political risk to get into the better companies at the lower prices. Other people might reach the opposite conclusion, and everybody is more worried about China now than they were 2 or 3 years ago. So that's just the way it is.
I have nothing to add. Okay. Station 8.
Hi, Warren and Charlie. My name is Tom Ringe. I'm from Wayne, Pennsylvania. It's great to be back here after 2 years. Thank you very much.
Thanks for coming.
In this year's letter, you talked about insurance float, the evolution of float, the per share float, the effect on repurchase to increase the per share float. And in regard to the repurchase, I would say thank you as your partner for your careful repurchase as well as careful issuance of our shares. My question is about your expectation for the likelihood that float will be stable and the cost will be zero or close to that over time with adverse years from time to time. What about Berkshire's insurance businesses give you the confidence to make that statement when your competitors are trying to do the same thing but haven't been able to come close to achieving Berkshire's record in cost and growth of float? Thank you.
Yeah, well, they really aren't trying to do the same thing, which is kind of interesting. The answer to your question is we wouldn't be in the business unless it was my judgment that the likelihood, the weighted probabilities are higher that the flow will be useful to us rather than costly to us. And nobody will know the answer to that for a very long time. So far, so good. But it is a judgment, and absolutely I could be wrong about it. But you know, I think both Charlie and I would say that we think the odds are that it's a winning bet, and the odds are pretty good, and that we're quite well positioned to do it if anybody does it. But, you know, did we know 9/11 was coming? Or, you know, I mean, it is not a sure thing.
Just think of what the potential is, though, when you're reviewing it. If we could buy common stocks we were virtually sure would give us 8% after taxes with our whole float, that would be a hell of a lot of money.
Well, it'd be 11 billion. I can tell you what it'd be. And 11 or 12 billion.
Yes, it's an enormous amount of money.
Annually.
Yes, and the float has been growing. So relax. We're glad to have the float.
But Charlie stuck in a couple of ifs there. If we could earn it, and if we could. The answer is, you know, it's our job, and we think we can do it as well as anybody, or we wouldn't be doing it. But it's our job to figure out what businesses we want to be in, and when they don't make sense, reluctantly, occasionally, to give up on them, like the textile business. But those are the hard decisions, and insurance. We didn't have the faintest idea back in 1967 when Jack Ringwald stopped by the office at he stopped by at about 11:45, and Charlie Hyder set him up. And Jack, about once a year, he'd get mad at the regulators. He just didn't like being regulated. And he'd say to himself, you know, I'm going to sell this damn thing. And Charlie caught him one day, and he said, Jack is in the heat. You know, I said, bring him around. So he came up, and 11:45, and Jack said he wanted to get rid of this damn business. The regulators were driving him nuts or something. And I said, fine, I'll buy it. And I said, what price do you want? And he said, I think $50 a share then. I said, fine, we've done it. We don't need an audit. We don't need anything. And then Jack started, and he says, immediately, he really changed his mind, but he was too honorable to back out. So he said, well, I suppose you'll want me to sell you the agencies. And I said, no. And of course, if I'd said yes, and then he said, well, then we can't do it. So I just said, no, yeah, keep them, Jack. You know. And he said, I suppose you'll want me to do this. I said, no, I won't want you to do that. He was hoping I would just give him an out. But after doing that for 15 or 20 minutes, he saw that I was going to agree to everything he said, and he said he'd sell it to me at 50, so he followed through, and that was that. And, you know, it was pure luck.
But Jack, Warren, we really like our float, don't we?
Pardon me?
We really like our float.
Oh, yeah.
No, we love it.
No, we made the most of it, but we didn't make the most of it till Ajit came along. And, who knew that a guy was going to walk into my office in 1986 and I would decide that he was the guy to make this damn thing work that I hadn't been able to make work the way I wanted it to. And who knew that Geico would come along later, and who knew it? There's just all kinds of things. The one thing you have to do is be prepared. When opportunity comes, you really do have to just move. And fortunately, I operate in an environment, and I wouldn't operate in any other environment. I get out of there, but I operate in an environment where I can do it. And it'd be crazy of the board to say, we want to set up a committee to review every acquisition and all that. And I would say that's fine, but you can work with somebody else, because I just don't like to go through all that stuff. I've got other things to do the rest of my life. There's so much luck, but there is that. You do have to be mentally prepared and to do something when it makes sense, and do it big time, and do it instantly. And then you got to be sure you've got the resources to do it. And,
the relative absence of bureaucracy at Berkshire,
unbelievable,
has made the company a lot of extra money for a very, very long time.
And it's made my life happier.
And yes, but that's ideal.
But in the end, we are extraordinarily well positioned to do exactly what we want to do with float, while at the same time never putting ourselves in the position, never coming close to making a promise we can't keep. We had two small insurance subsidiaries well before Ajit. Two companies I'd bought. One I really didn't know that much about. The other one, I did it all by myself. And they were disasters. And left alone, which they could have been, they'd have gone bankrupt. And we just didn't want to do it. So, we could pay the liabilities, and if the parent company got involved, or we put it in another insurance company or something, and we did it. I mean, it's Berkshire. In a crazy way, I look at Berkshire as a painting, and it's unlimited in size. It's got an ever-expanding canvas, and I get to paint what I want. And if somebody wants to paint something else, then I'll go someplace, and I'll get a smaller little thing, and I'll paint away. And I actually, I'm no good. I don't know anything about paintings. Take me to an art museum, and all I really want to know is where the men's room is. But I'm just not interested. And other people look at paintings, and they see something, and then they see something additionally later on. And I mean, they really have a different sort of perception ability in relation to that. And to me, Berkshire's a painting, and I get to paint. And the object, obviously, I want my partners to come out well in it, but the real thing I like is the painting. And as long as it's in my head, and I see different things in it as I go along, and it's the closest thing I can come to enjoying myself every minute of the day. And it's not, I don't prescribe it for other people. And occasionally not so occasionally, but I see things in the painting, I think, well, I should have done that differently, and I go back and paint it over, and it's satisfying. And who knows why human beings react in that manner, but I do know what makes me happy and what doesn't make me happy. I found what makes me happy, so why in the world would I change it? So that's a short answer to a question that I can't remember what it was. Okay. Becky.
This question comes from Andrew Kiesau from Minneapolis, Minnesota. He says, last year, Warren mentioned that inflation had noticeably impacted the prices that Berkshire's businesses were paying and charging. Given those inflationary trends have continued and in some cases accelerated since last year's meeting, could you comment on how this particular inflationary period ranks among previous such periods in the United States, like the 1970s and 1980s? And what can American businesses and citizens do to reduce the negative impacts that inflation brings about?
Well, we've sort of attacked what you do yourself. And you develop skills that people are willing to pay for in the future, regardless of what the unit of exchange is. But in terms of inflation in our own businesses, it's extraordinary how much we've seen. I think you interviewed Herb Lumpkin at the Furniture Mart, and for 2 years, the prices have just kept coming in higher for these things, and we sell them for higher prices, and people have more money than they've had before, and they like to buy. And there's certain things they can't buy. It's like during World War II, you had a lot of money created, and people couldn't buy cars, and they couldn't buy refrigerators, and they couldn't even buy as much sugar or coffee or things as they wanted. They had little stamps and gasoline and all kinds of things. Well, eventually, if you get a lot of money in people's hands and you don't have very many goods, prices go up. Now, you can do all kinds of things to try and talk it down. And of course, inflation is never the same. Nothing in economics is the same the second time after it happens than the first, because the first affects people's attitudes, and the second, their attitudes always influence the activity itself. I mean, it is an interesting phenomenon. People write a textbook, and they write it based on the last experience, and people read the textbook so they behave differently next time, and then they wonder why they're getting a different result than they got the time before. So anyway, we have sent out lots and lots and lots. When I say we, I mean the United States government. The government has set out lots of money to people. And at some point, the money can't be worth as much as it was when there was less money out. Here's an interesting figure that I think probably will astound you. Sounds me anyway. The Federal Reserve every Thursday puts out a balance sheet. The Federal Reserve and Treasury, they're complicated institutions, but they do put out this kind of consolidated statement of all the various Federal Reserve banks, all these things that have entered into legislation over the years. But there's a balance sheet. And 15 years ago, roughly, if you look, the Federal Reserve issues those notes I talked about a while back, and that's the one, here's the current one, and they print these pieces of paper. And they, one way or another, they got it in the hands of people. Well, the interesting thing is, people said cash is dead and all that sort of thing, cashless society. Well, there were 800 billion, go back 10 or 15 years, but there was about 800 billion of currency in circulation. And if you look at last Thursday's report, you'll see there's something like now $2.2 trillion of currency in circulation, 2.2 trillion. Now there's about, there's 330 million people in the United States. Let's look at it that way. And with 330 million people, and you have almost 2.3 trillion of currency in circulation, that's $7,000 per person, every man, woman, and child, in theory, has $7,000 worth of currency. Well, that isn't right, but you do know that the Federal Reserve's bookkeeping is essentially right. They've got that much that's out there. I don't know where it is. I mean, I don't know whether it's in Russia. I don't know whether it's in South America. I don't know where. I don't know whether Charlie's got it all. I mean, it's a staggering sum. Cash is dead, and yet we, on average, have $7,000 for every person in the United States. Now, while you're absorbing that, think for a moment what would happen if the U.S. government said, well, they work it out in private, and they decide that they're going to send Federal Reserve, and I'm not going to blame the Federal Reserve for this. Somebody back in Washington decides that they're going to send out $1 million to every household in the United States. And there are 130 million households in the United States or something like that, and they're going to mail you $1 million in cash. And there were a couple of provisions attached to it. One is, if you talked about it in the next 30 days, the money disappeared. So it was like in one of those old TV shows or something, and poof, disappears. And after 30 days, you could spend it. Well, all of a sudden, the household wealth of the United States, Federal Reserve puts out an estimate, is 130 trillion or something like that. So basically, you've doubled the household wealth. And all you've done is mail out people. But then you don't tell them you're doing it with everybody. You just say they won the lottery or whatever it may be. And now you've got an amount equal to household wealth. You've got on average, people have doubled it. They've got this extra 130 trillion of wealth, and in a month they can spend it. Well, what's going to happen? Well, prices are going to go up, but are they going to go up immediately? Well, you don't know the other guy got it. You just know you've got it. So you don't really feel like you got to rush out and buy things. But as soon as word gets around, well, we've mailed out. If you look at the amount we've distributed, the federal government, I'm just talking about the distribution of resources. We're talking numbers like that, and it affects prices. It has to affect prices. If you had 10 times as much, if you went home and you had 10 times the net worth you had yesterday, but everybody else did the same thing, it doesn't increase the amount of bread in the economy or the number of cars. It just means that the price, the value of this is going to go down, and its purchasing power, you can't buy more than exists. So it's a very strange period where we had lots of money sent out to people, one way or another we're getting it, that they didn't find as many things to buy as before, and we had supply chain disruption. We have all these things happen. But the end of it is they go out to the Nebraska Furniture Mart and they just start buying things. And they do it with our other companies. And they do it in very peculiar ways. And now they're buying, one thing, jewelry stores were, generally speaking, not a very good business. And 2 years ago, every landlord that had a jewelry store or multiple jewelry stores in their mall, was wondering how they were going to get their rent. And now every jewelry store virtually is doing incredibly better than they ever dreamt, with way less inventory, because people just come in and buy. And they don't wait for sales. When they walk in the store, they're going to walk out and they're going to have bought something, and they pay for it. They got the money. So we are seeing an unleashing of the fact that we've just mailed a lot of money to people, one way or another. It's very indirect. It all gets complicated when we talk about a big system, but this is what's happened. And I will guarantee you that if we mail out $1 million to every household in the United States tonight, and you don't know that it's happened, you don't really expect much to happen in behavior tomorrow. But somehow, at some point, and then if you start doing it every month, we'll say, and people really know you're doing it, then they start anticipating it and buying ahead of time and forward. I mean, there's a million things that happen in economics. But the answer is, we've had a lot of inflation, and it was almost impossible not to have if you're going to mail out the kind of money we've mailed out. And it's probably a good thing we did it. In fact, I think there was one point when the Federal Reserve, which in effect creates the money, if they hadn't done it, your lives would be a lot worse, a whole lot worse now. And that was an important decision. And that's the way that's why you've had inflation. And heaven knows, I mean, it could end. You can throw the country into recession. You can do all kinds of things. The country's going to have recessions, incidentally, and it's going to have depressions periodically. And things will happen differently. And you'll read a newspaper today, and you'll wonder a year from now, why was I reading the newspaper a year ago? I mean, it's just the way it works. When I bought the first stock in 1942, did I know everything was going to happen afterwards? Of course not. I didn't know a damn thing. But I just needed to have one idea, and that idea wasn't really well formed. It was just probably the way practically every kid felt about the country when we just gone into a war. We thought America was going to win, and America was going to win then. It was going to win just generally, and savings bonds were paying 2.9%. I learned that because we bought them. They called them war bonds originally, and they called them defense bonds, and they called them savings bonds, but they were the same thing. And you print loads of money, and money is going to be worth less. Not worthless. I got in trouble doing that one time with CNBC because I said it was going to be worth separately less, but it got contracted down to worthless. So it took me a few years to learn to separate those words somehow. Anyway, that's everything I know about economics and more, and Charlie can probably improve on it.
Well, it happened on a scale this time we'd never seen before. Those checks that were just mailed out to everybody who claimed to have a business and claimed to have employees, they probably drowned the country in money for a while. And as you say, they probably had to do it. But it was something that had never been done on that scale before.
But we had a problem we hadn't had before.
Yes. No, I'm not saying it wasn't a good idea.
I mean, in my book, Jay Powell's a hero. I mean, it's very, very simple. I mean, he did what he had to do. If he had done nothing, it would be he would be, it'd be very easy to engage in what you would call thumb sucking then. And I shouldn't say plenty of, but there are other Fed chairmen that would have been sucking their thumbs, and the world would have fallen around them. And nobody would have exactly blamed them. They would have blamed the virus and the Chinese and all kinds of things.
Well, the really interesting company is Japan, where first they buy back all the debt, then they start buying back all the common stocks. Now that's really weird. And what did they get? 25 years of stasis. Who would have predicted that?
Well, nobody predicted anything. I mean, there's nobody's predictions that we're interested in, including our own. I mean, it's very simple. What we do know is that we can deserve your trust, and there's no reason to do things that don't deserve it, and we can't tell what. But basically, we think we're trying to build a Berkshire that can't withstand a nuclear exchange, but it can withstand withstand as much as anything that we can do anything about. And that leaves us feeling good. It doesn't leave us feeling perfect. We'd like to even promise you more than that, but we can't promise more than that. So it's very simple. And with that, we'll move on to 18. Let's see, that's station 9.
Dear Mr. Buffett and Mr. Munger, I'm Ili Abushakra from Montreal, Canada. I would like to thank you for everything you've done for us, your fellow shareholder. My question is regarding the GAAP rules. If you were to change it, what would you change and what it would look like? Thank you.
Well, I would resign the job. What would you do, Charlie? No, it's an impossible problem because, first of all, you have to decide what GAAP is supposed to reflect, and it doesn't reflect value. But in certain cases, of course, it is important to say that this is value and so on. I mean, it's a convention, and it is done so that the auditor generally is protected, because otherwise everybody sues everybody in this country for anything. And it's designed to cause people who want to report a given amount of whatever is desired by the market to largely be able to do it. I don't know how I would write the rules. I mean, I've watched people who I would be delighted to have live next to me. You know, if I was going away for 2 weeks and my kids were to stay at somebody's house, it'd be fine with me if they stayed there. If I lost my wallet someplace and they found it, they'd return it to me. But they'd play games with any number that came to them. And of course, it's a very awkward thing to be on the audit committee of a company where people are playing around with the numbers, and they don't want you. If you raise a stink, you've got all kinds of problems. And I actually wrote something some years ago I was kind of anticipating your question about 15 years ago, I guess, and I wrote 4 suggestions for questions to be asked of the audit committee. And I don't know whether I was on the audit committee then of Coke or where. But anyway, it was just clear to me what was happening. But you really had to follow the charade, or you got in all kinds of trouble for doing that too. And so I just put 4 questions out that I would want to know, and they were perfectly logical questions. And in the end, nobody adopted them. I mean, the system was fine as it was. The auditors got sued, but not that often. And the SEC had lots of rules, and I admired the SEC enormously. I think the country is better off because of the SEC, but it is a hopeless problem to devise rules that people can't get around. I mean, it's not. I think it was, who was it that my friend that was a writer said, it's not the illegal things that are outrageous, it's the legal things. It's very hard. You try, and it's worthwhile. You need an SEC, but the SEC can't really stop the stuff that you would find outrageous. Explained, and the auditors have the same question. I mean, the auditors really want rules, and they want processes, and they want it to be so they can operate. Charlie he was on the audit committee of Solomon, and we had probably literally millions of contracts where people put numbers in, And he found that $20 million, we had the largest auditing firm in the country then, Arthur Andersen, as I remembered.
They're gone now.
Yeah, they're gone now, but they were the largest. And Charlie found a $20 million error, I think, one time in an audit.
They call it a plug. When your accountant starts talking about a plug, it's not good.
Well, I'll tell you a story I haven't told before. You saw in that movie, people who were here saw me testify in August before a subcommittee who were out to, get their way, and I just decided I was just going to answer every question honestly, and I was not going to try and draw up anything. So I just sat in front of them and said what I knew and didn't know. And one of the things I said, which was absolutely true, is that I'd only been there 10 days or so at Solomon, but I said I really haven't seen anything yet that strikes me as terrible in accounting. But I've been there 10 days. But this guy who got us in all this trouble, so far, he's the only thing I found. I don't know what else was going to be found. How in the hell could I know what had gone in a place that was doing, incredible numbers of transactions and everything? Well, but I said, what I've seen, the accounting strikes me as legit. About a month later, I was so happy I'd testified earlier, not later, a very fine CFO, and these are decent people. They're very decent people. And he comes in and he said, Warren, there's probably something you should know. And I said, well, what's that? He said, well, 12 years earlier, or whatever it was, Solomon had merged with Fibro, which was a huge trading company. Solomon was a huge investment banking company. It became this huge powerhouse. And he said, 12 years ago when we merged with him, we sort of couldn't find exactly, they were on a trade basis and we were on a settlement basis. And they said, we've never really figured out how to put the books together. This is the largest audit company in the United States, Arthur Andersen, that's responsible for signing this thing. So we have this number, and every day it moves around. And it's just put in there to make assets equal liabilities. and today it's 173,412,000, it's down to a penny, and tomorrow it'll be something different. And I thought to myself, I am sure glad I testified before Congress a month ago, because I did not know then. But if they ever ask me again, I'm going to tell them exactly what happened. That we just got this number that floats around every day, and we haven't found it in 12 years. And Arthur Andersen doesn't know where it is. and you got to make the assets equal to the liabilities, right? I mean, so what else do you do? And that's exactly what happened. And strange things happen in this world. There's one thing
the name was the floating plug.
Yeah. Yeah. And Charlie's on the audit committee. Yeah. Yeah, the one thing I've always suggested, nobody ever wants to do this. And I can understand why. But you've got trillions of dollars worth of contracts and everything that people are putting down little numbers for every day at banks and investment banks and all over the world. I mean, commodity traders. And at Berkshire, we stick down something. There's certain hedging that even the regulators want us to do in terms of giving utilities, and we put a little number in. And I've made the suggestion once or twice that if you really want to do something sort of interesting, just get some young guy that give him a couple of weeks and pick the 100 most kind of complicated, long-term, lots of wording, derivative contracts, and look at what one side, who promises to do something, values it at, and look at what the other side, who also reports. And and just let them do it for 100 operations at random. I just like to know if somebody's valuing we're valuing a contract at $28 million, the other guy's valuing it at $33 million, and you've got the same auditing firm in both cases, and they're signing their name to them. I don't think anybody's ever done anything with that suggestion. It's, that would be the first thing I would do, actually, if I really wanted to sort of dig into what was happening in accounting. But there's a lot of things in life you can't change, and nobody is going to go looking for ways to create lawsuits and newspaper stories, all kinds of things, and I don't blame them. I brought one thing I just couldn't resist. I was hoping I'd get a question, so I'll ask it myself. I was hoping to get a question that, how could some guy be so idiotic as to propose a price of $848.02 or whatever it was, or is, for Allegheny Court? I mean, isn't that getting a little scientific? And of course, I did provide, when I made the offer, that it'd be $850 less whatever was paid to whatever investment banker they wanted to select, Allegheny in this case. And they're bound to have to do it because Delaware law is developed in such a way that the directors are protected if they get expert opinions, all that sort of thing. So I don't fault anybody in the system, but I just thought it might be useful, actually, maybe to Delaware judges someday, Delaware statute makers, maybe people that are writing papers, who knows? But I suggested that we just, since I'm willing to pay $850 a share for the place as is, if the audit fees if the advisory fees are $10 million or $40 million, that it makes a difference to someone. And it's always made a difference to us as the buyer, but that's just the way the game was. Well, there's a little history to that. And I went back, and there's been twice nobody's ever paid attention to this, but there's been twice in the history of Berkshire Hathaway, 57 years, twice that Berkshire was required to get a fairness opinion. And it was perfectly logical that we be required to get a fairness opinion in those two cases, because in one case, Diversified Retailing, which was a company I was invested in both of them that came out of our partnership, but one had a group of shareholders that were different than the other group of shareholders at Berkshire, and the two want to merge. So you have two companies with me being the biggest beneficiary in between. And it wasn't up to me to determine the ratio. I mean, even though I had the most involved, but I had a little more of one company than the other. So anyway, a fairness and opinion was required. And this has only been twice in the history of Berkshire that one was required. So naturally, I went to Charlie. I said, Charlie, we do have to, Charlie told me, he knew it better than I did. We need a fairness opinion in this case. And I said, I know what's fair. You know what's fair. Sandy knows what he thinks is fair. If the three of us owned it, in 10 minutes, we could have worked out a deal that all three of us regarded as fair. But because there were public shareholders and everything, it wasn't right to do it that way. And the first one, we have two of these, but the first one was November 27th, 1978. And I told the shareholders, essentially, that my personal belief is that both Diversified and Berkshire shareholders will benefit from the merger, but I will vote for the merger only if a majority of the shares which are voted by other shareholders of each company are voted to support it. So, which was fine. I committed myself, that let the other people decide whether this is fair, but on top of that, we needed to get a fairness opinion from an investment bank with a big name and everything. And so I said to Charlie, I said, these things are going for $1 million or $2 million, where they get some guy that they hired last week, and he writes up a little thing, and then we get a bill for $1 million or $2 million. They really haven't done anything. They don't know either company, and there's a million things they're not going to know about it, but they're going to write an opinion, and we need the opinion. I said, so what do I do? I go to Charlie with these kind of problems. And Charlie said, Warren, it's very simple. He said, pick out 10 prestigious investment banks and do exactly what I say. So, okay, Charlie, what do I do? When I call and get these 10? He says, well, put them in order, 1 through 10. And he said, call the guy at the top of the list and tell him you'll pay him $60,000 for doing a fairness opinion. And you know that it's an insulting price, and it's ridiculous for him to do it because it'll affect what he can get from other people down the line. They'll look back and they'll say, well, Buffett only paid $60,000. Why should I pay $2 million? And but he said, just tell him that's what you'll pay. And if they're insulted by it, which they probably should be, then you'll go to number 2. And they'll offer them the same deal. And you'll just keep going down until you get to number 10. And if you don't have anybody by number 10, you've told the other people, you'll come back to number 1 again. And you'll say, well, I'll pay $80,000. And then you'll go down the list and everything. Well, so I picked 10 names out. And number 1 name was Jack Shadd. And Jack Shadd was a friend of Tom Murphy's, a friend of Bill Ruane's, and he was running E.F. Hutton, and he was a very, very, very successful investment banker. I didn't know him as well as the others, but I'd met him through my friends. So I called up and I said, Jack, I said, I've got this crazy request. He says, only because everybody admires you so much, and my friends are your friends, and blah, 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 and E.F. Hutton is so well regarded. I said, I'm going to do something I'm going to ask you something that is totally against your interest, and I fully understand the fact that you're going to say, you're an idiot to call me on this and slam down the phone. But I said, Jack, here's our procedure. And I described this procedure that he gets called first, and if he turns it down, then I go to Payne Weber, and then I go to and I go through it. And I tell him, there's these 10 people. And if we don't get any yeses, I'm going to come back to you again, and I'll offer you 75, and we'll do the same thing till somebody says yes. And I said, Jack, but you are the first call. So $60,000, and it's going to screw up your business if you do this, because every client you get in the future is going to say, well, you did it for diversified retailing and Berkshire, and why in the world should we pay you $2 million when he paid you $60,000? And Jack said, don't worry about it, Warren. I can take care of that. He says, we're in. And so we got a fairness opinion written for one side. And now the next call I made was to Payne Weber, and I gave him the same story. And I said E.F. Hutton was dumb enough to take the one side for $60,000. I don't know why the hell they're doing it. They're destroying their reputation and all that. And Payne Weber said, we'll take the other side for $60,000. So we have a thing here that describes the whole process. And
they got well low. They sent out an amiable alcoholic they had to do something with.
Well, what they did was they each billed us for $60,000, and we paid it.
That's what you get for $60,000.
No. We got the same thing everybody else got, Charlie. And of course, Jack Shadd, this was 1978, he was appointed chairman of the SEC for 7 years. I mean, Jack liked to do business. And it's true, it didn't hurt him. They paid us $60,000, and they went back and charged somebody else $2 million. the next week. And those guys, it's all play money. And so we did the same thing when we got to blue chip stamps, where we were similarly conflicted 4 or 5 years later. We went back to the same two guys, and there'd been a lot of inflation and everything like that. So we said 110,000 then. I've got the prospectus for that. And both of them said, send it in, don't worry about our other clients. We'll figure out some story to tell them, and whatever it may be. But I just thought it would be interesting to, at some point, have people realize that it's not play money. Somebody pays it. And it's a game. And, but it's what passes muster in Delaware, and the directors will have it explained to them by the lawyers that they're not going to get sued if they do it in a certain kind of way. And, so I just decided that somebody at some point ought to point out what actually is happening in this situation. And that's why we did it that way. And it may go down with our earlier attempts to educate the world on the realities of finance and its various interactions, and why it's better to teach your son to be an investment banker than to be an electrician, or something. But you've got an eccentric chairman, and that's what he did. Charlie, how do you feel about this whole matter? It was your idea, originally.
Well, we're a little peculiar. And it's not all the peculiarities are not bad.
I talked to Charlie before. And I didn't talk to Charlie before I did it this time. But Charlie has given me 4 ideas together that on extremely practical matters were so much. They just changed everything. I think you really ought to tell about the experience with the fraud claim.
What?
On the fraud claim, the fidelity claim with the guy. You had the very well-known insurance company that you don't have to name names, but where you basically told them just raise the stakes to make the game fair. This was back in the 1960s. Do you remember that?
I don't remember.
Oh, well, I do. I remember it.
Well, tell it then.
Charlie had this tiny little operation which he ran his fund, also had a seat on the Pacific Coast Stock Exchange. The firm was called Wheeler and Munger. It was called Wheeler and Munger at first. Later it changed itself to Munger Wheeler. And Jack Wheeler said, well, pretty soon it'll be Munger and Company, but that's okay. Jack Wheeler was a very interesting guy, and he had the specialist position in General Motors and a few things. And some employee stole I don't know, $12,000 or something like that from the firm.
I remember, he hid the trading tickets.
Yeah, some guy steals some money. And Charlie's firm, Wheeler and Munger, was required to have a fidelity bond and all these things that covered dishonest employees and all of that sort. So this guy's clearly dishonest. He's clearly stolen the money. So Charlie puts in a claim for $12,000 or something like that, whatever the loss was, and sends it to this very big and prestigious insurance company. And of course, the insurance company denies his claim. They say, the guy really wasn't employed, he doesn't exist, you don't have a dog, I mean, the whole thing. And Charlie gets this letter back, and they're not going to pay the claim. And so Charlie writes a letter to this very well-known, big-name person that runs the insurance company. And he said, he said, we have this $12,000 claim. And he said, this guy stole the money. And we thought we had an insurance policy against people stealing, to pay us people stole money. And he said, we're in this very interesting position because you've got a bunch of people on the payroll, and they're going to get their weekly check or monthly check, whatever they do, So they just say, we're not going to pay, and life goes on. Whereas I'm sitting here, and I've got my time. I got to work on this thing, and it isn't worth the $12,000 for me to fool around with this claim against the company, and they'll appeal it and all these things. So he said, I know that you would be offended by the thought that you might be using this inequality of bargaining position to avoid paying at the claim. That never could be your intention. So what I suggest, in order to really live up to your code of behavior, is why don't we make the $12,000 claim, we'll just multiply it by 10 and call it $120,000 either way. And if you lose, you pay me $120,000. If I lose, I'll pay you $120,000. Now it's worth my while. And he addresses the letter to the chairman and says that's the guy. He gets a $12,000 check by return mail. It's not a bad lesson. He's told me 2 others, but the tricks are too good. I don't even want to share them now. I may use them myself someday. Okay, let's go to Becky.
We got a lot of questions on this topic. I'll ask this one that came from Raj. He says, have you changed your views on Bitcoin and or cryptocurrency in any respect? I'm conflicted about this because his own views have slightly evolved during the past 2 years, from Bitcoin as a fraud and waste to Bitcoin is in a speculative bubble but might have some uses.
Well, I shouldn't answer any questions on the subject, but I will. There's all kinds of people watching this that are long Bitcoin, and there's nobody that's short, and nobody wants their windpipe stepped on. And I don't blame them. I don't like people who step on my windpipe. But I would say this, that if the people in this room owned all of the farmland in the United States, and you offered me a 1% interest in it, and you said, for a 1% interest in all the farmland in the United States, pay our group, well, let's see, 10 trillion, pay us this bargain price, $25 billion. I'll write you a check this afternoon, $25 billion, now I own 1% of the farmland. If you tell me you own 1% of the apartment houses in the United States, and you offer me a 1% interest, so I'll have a 1% interest in all the apartment houses in the country, and you want whatever it may be for it, then call it another $25 billion or something. I'll write you a check. It's very simple. Now, if you told me you owned all of the Bitcoin in the world and you offered it to me for $25, I wouldn't take it, because what would I do with it? I have to sell it back to you one way or another. I mean, maybe I have the same people, but it isn't going to do anything. The apartments are going to produce rental, and the farms are going to produce food. And if I've got all the Bitcoin, I'm back where whatever his name was, who may or may not have existed, was 15 years ago. If I've got it all, he could create a mystery about it. But everybody knows what I'm like. I mean, so if I'm trying to get rid of it, people will say, well, why should I buy some Bitcoin from you? I mean, why don't you call it Buffett coin? Make your own or something. What? Do something. But I'm not going to give you anything for it. And you'd be right, incidentally. But that explains the difference between productive assets and something that depends on the next guy paying you more than the last guy got. Now, net, if you look at it, a lot of commissions have been paid, and there's all kinds of frictional costs that are very real that somebody has paid to a bunch of people who facilitate this game. But whatever one group of the public has taken out, or one group of owners, has come in from other people. I mean, other people have entered the room and they move money around, but no money there's no more money in the room. It just changed hands with a lot of maybe fraud and costs involved and, a whole bunch of things. You lose, you forget the numbers or forget the equation. You can do that with a lot of things. I mean, it's been done throughout history. Certain things have value that don't produce something tangible. I mean, you can say a great painting, probably will have some value 500 years from now. May not, but the odds are pretty good that if it was a big enough name, at some point, there will be a few things. I mean, you can find something. If somebody wants to sell you a pyramid or something, and you can charge the viewers, or it'll be around a long time and won't produce anything. But people will find it interesting to go there because they've read about the pyramids. But basically, assets to have value, they have to deliver something to somebody, and there's only one currency that's acceptable in the United States. I mean, you can come up with all kinds of things. We can put out Berkshire coins, or we can put out Berkshire money or anything like that. But we get in trouble, I guess, if we call it money. But in the end, this is money, and there's no reason in the world why the United States government, whose currency people prefer, there's just under 2.3 trillion just of these little pieces of paper floating around some places, 7,000 for every man, woman, and child in the United States. And of course, most of them probably aren't in the United States. Who knows? But this is the only thing that's money. And anybody that thinks the United States is going to change to where they let Berkshire money replace theirs, is out of their mind. I mean, so anyway, with those few deficiencies, you can, whether it goes up or down in the next year or 5 years, 10 years, I don't know. But the one thing I'm pretty sure of is that it doesn't multiply, it doesn't produce anything. It's got a magic to it, and people have attached magics to lots of things. I mean, the gold in Wall Street, create magic. We are not an insurance company, we're a tech company. Well, they're an insurance company, but a dozen people or so have raised a lot of money. They just say, just don't pay any attention to the fact that we sell insurance. We are a tech company. Well, in the end, they wrote insurance, and overwhelmingly, they've lost a lot of money since then. You can make up things that work well in getting money from other people, and that's why.
Well, I have a slightly different way of looking at it.
I'll sell you some then.
Well, in my life, I try and avoid things that are stupid and evil and make me look bad in comparison with somebody else. And Bitcoin does all three. And in the first place, it's stupid because it's very likely to go to zero. In the second place, it's evil because it undermines the Federal Reserve System and the national currency system, which we desperately need to maintain its integrity and government control and so on. And third, it makes us look foolish compared to the communist leader in China. He was smart enough to ban Bitcoin in China. And with all of our presumed advantages of civilization, we are a lot dumber than the communist leader in China.
Yeah, and when 25% of the people of the country get mad because we've said what we've said today, just remember Charlie spoke last and was the most... the one development that I really do think is actually important, but I don't know any way to do anything about it. But my general sense, and there's no way to prove it, but I essentially believe people are now behaving somewhat more tribal than they have for a long time. And I mean, people are always going to be partisan, and they're going to have religious beliefs. They're going to have all kinds of things. But it gets pretty tribal. And I want to tell you, I speak from experience because I've been tribal. And, we're confessing today. Nebraska football is tribal. And when I watch a television set and I see our guys Nebraska step out of bounds by a foot, but somehow the ref misses it and calls it in, and then they show 6 replays, I'll continue to believe it was in, even though it's right in front of my eyes. They stepped out. That's tribal behavior. And it's fun. I mean, to participate in. But it can get very dangerous when one group of people say 2 + 2 is 5, and another say it's 2 + 2 is 3, and they're going to give you those answers if you call them. And the interesting thing is, to me, at least, and partly because of my age, but I actually think that, just from memory, that the last time that the country was seen as tribal was actually when I was a kid and Roosevelt was in. Either you hated Roosevelt or you loved him. I mean, nobody cared about the fact Alf Landon was running or Wendell Willkie was running against him. They just had these feelings. They either had Roosevelt's picture on the wall and named their kids after Roosevelt, or they hated him. And they thought he was going to, no third term, and, a million things. And the country was very, very tribal in the 30s, but Roosevelt's tribe was bigger. And in my opinion, they did some wonderful things, but I happened to grow up in a household where we didn't get served dessert until we said something nasty about Roosevelt. I mean, I'm speaking. And believe me, if you don't get dessert, you're going to say something nasty about Roosevelt. And so you trained them young, and all kinds of things. And so I think I've seen a period that it wasn't that way when, if Eisenhower was running against Stevenson or whatever it might be. I mean, people, they had a partisan behavior, and they had a certain amount of tribal always, but I don't think it's a good development for society generally when people get tribal, regardless. I mean, Charlie, what tribes are you members of?
Well, in California, we have a legislature which is completely gerrymandered, so nobody can ever be thrown out by the voters. And therefore, the only people in the legislature are insane rightists and insane leftists. And they get together every 10 years, and there's usually 6 moderates somewhere in the legislature. And so they rejigger all the districts to throw them out, because neither party can stand them. Now, that is government in California.
Yeah. And you live there and you have to go back?
Yes.
I'm sure you'll have a welcome.
And I prefer living there to living in Russia.
Okay, who haven't we gotten in trouble with? Who was it, Lenny Bruce, that you say, is there anyone I've forgotten to offend? The Section 10, I believe.
Hello, Mr. Buffett and Mr. Munger. My name is Sahej. I'm from New Jersey, and I'm currently a freshman at Rutgers University. You knew quite early on that you wanted to be investors and you've obviously been amazing at it. What advice would you have for someone who's still trying to figure out what they want to focus on and find their calling?
Well, it is a very interesting question, because I was very, very lucky in that I found what I wanted to do, because my dad happened to be in a business that he wasn't interested in, but they had some books down there, and I loved my dad, and I'd go down and read the books, and they interested me. And, you know, I'm glad he wasn't a professional boxer or something, or I wouldn't have any teeth left or anything. It was accident, just totally accident. But I do think you know it when you see it, and it doesn't mean you can follow it. I would tell the students, wrote in the report, I mean, find out what you love doing it. You spend most of your life doing it, and why in the world would you want to be around for a lifetime working with people that you didn't like unless you had to, which sometimes happens, and just work for whomever you admire the most. And I gave the talk at Stanford one time, and somebody showed up at Tom Murphy's office, I think, a couple of days later. I mean, that person was right. And of course, it's what I did when I got out of school. I wanted to work for Ben Graham. I mean, I didn't care what I got paid. It didn't make any, I just knew that that's what I wanted to do. And then I pestered him for 3 years, and he finally hired me. And then I found somebody else that I'd even rather work for than Ben, who happened to be myself. So I've been working for myself ever since. But I had about 4 bosses in my life. Down the Lincoln Journal, name slips my mind at the moment. He's a wonderful boss. It was Cooper Smith at J.C. Penney's here in Omaha, and they all were wonderful people. But I still preferred working for myself. And of course, Charlie and I both worked for my grandfather, and we just didn't find it that interesting. I don't remember why'd you ever decide to go to work at the store, Charlie? Charlie worked there in 1940.
I worked just for the experience of working. I didn't need the money. My father gave me an ample allowance, and I also had a private business. So I was kind of working as a lark in your grocery store.
12 hours a day?
Yes.
For a lark?
Yeah, as a lark, yes.
Do you consider that a good investment of your time? I'm just looking back on it.
Well, I had never done it before, and I wanted to have a little of that experience, and I wasn't going to do it very long.
That sure as hell wasn't the reason I worked.
Well,
but
I could give that young lady the advice, figure out what you're bad at and avoid all of it.
Yeah.
That's the way Warren and I found our profession.
Absolutely. We
failed at everything else.
We worked at everything till we found the ideal employers ourselves. And that was something we really admired.
Yeah, I know. Warren said work for somebody you admire. The only one he knew was the one he was shaving.
Self-employed.
You see when he was shaving.
But it isn't bad advice. It isn't bad advice. I mean, who wants this? If they've got an option. I mean, if you're, Charlie went into the service in whatever year it was in the 40s, and he didn't really have a choice of who he was going to work for. And as I remember, it didn't really work out that well who you worked for, Charlie, did it?
Well, if you stop to think about it, the two things that neither one of us has ever succeeded at. One, we've never succeeded at anything that didn't interest us, right?
Right.
And we've never succeeded at anything that was really hard where we didn't have much aptitude for it.
Yeah, and we've been doing whatever we please for 60 years now. I mean, And we get, we have fun in our way. And
I'm just amazed. You'd think if you're smart, you could do things that don't interest you well, but you can't.
Well, I've certainly got a lot of examples in my own case, but we won't get into them here. And we will go to Becky.
This question comes from Foster Taylor in Tulsa, Oklahoma. He said he recently listened to the Berkshire Hathaway 2008 annual meeting where you talked about global oil production. At the time, you talked about major ramifications if global oil production went below 85 million barrels in 25 years. We are at the 14-year mark and global oil production looks to be 79 million barrels. At the same time, we're depleting our strategic oil reserves. Should the United States be doing something differently, and do you see consequences to these actions in the next 10 years if we do not become more proactive?
Well, Charlie's the expert on oil.
Well, that...
Only compared to me.
Samuel Johnson said it's hard to determine the order of precedency between a louse and a flea. It's hard to tell which of us is more incompetent in oil.
Yeah, we're still competing.
I have a different view on this subject. I like having big reserves of oil. If I were running the benevolent despot of the United States, I would just leave most of the oil we have here and I'd pay whatever the Arabs charge for their oil, and I'd pay it cheerfully and conserve my own. I think it's going to be very precious stuff over the next 200 years. And nobody else has my view, so it doesn't bother me. I just think they're all wrong.
Yeah. Well,
but at any rate, that is not the normal view.
And we've been pretty flexible in our own view. I mean, actually, the federal government is serving up however many billion barrels of the stuff that into the economy. And it wasn't that long ago that the idea that anybody produced a barrel of oil was somehow something terrible. I mean, just try doing without 11 million barrels a day and see what happens tomorrow. It is something that everybody has a feeling on immediately, and this gets into a whole bunch of different tribes of sorts, and you offend an awful lot of people if you talk in any way about it. But in the end, I think, at the moment at least, most people feel that it's nice to have some oil in this country than not have it, and we're using a lot of it. And if we were to try and change over in 3 years or 5 years, nobody knows what would happen, but the odds that it would work well are extremely low, it seems to me. Charlie, why don't you say something more dramatic so you'll be the one that offended the most people?
Well, if you stop to think about it, the oil industry is being so vilified now. I can hardly think of a more useful industry, and I don't know about wildcatters, but certainly the petroleum engineers I know, and the people who design our oil refineries and pipelines are some of the finest and most reliable people I know. And I see very little trouble with the oil supply thing in the United States. So I'm basically in love with Standard Oil. And I don't have this feeling that it's an evil, crazy place. I wish the rest of the world worked as well as our big oil companies.
Well, we better move on to Station 11. I'm not sure whether Station 11 is operative.
Well, we're here.
Okay.
Greetings from the overflow room. My name is Glenn Tung. I'm a shareholder from New York. This is my 20th Berkshire annual meeting, and I'm delighted that we're able to once again be here in person. You two have brought tremendous joy to all of us through the years, and speaking personally, your wisdom has not only made me a better investor, but more importantly, a better, happier person. It's a privilege and honor to thank you. So Warren and Charlie, thank you.
Well, that's my kind of a question.
Yeah, that's fine.
Let's have more of those.
Yeah. Or you can say it again. I mean,
maybe you could sing it.
Maybe I should quit at this point.
Then go to it.
My question relates to share repurchases. Since you started buying back Berkshire shares in size 2 years ago, the repurchases have ranged between $1 billion and $3 billion per month. By my estimate, it appears that the buyback rate is about $3 billion per month when Berkshire's trading at a 20 or so % discount to intrinsic value, $2 billion per month at about a 10% discount, and $1 billion per month at a 0 to 10% value. Do I have that about right and approximately right? And do any other factors influence the rate of share repurchases?
Well, after you were so nice in your introduction, I have to say that, that you're actually wrong in our. If somebody had offered us $50 billion worth of stock at a certain point in the last 3 or 4, 5 months, we'd have taken it. You know, it's that simple. And as I mentioned earlier, we haven't bought any stock in April. It's something that when we can do it, and we know, at least we think the probabilities are very high. We certainly believe it in terms of our own evaluation and our own investment. If we think that we're improving things for the remaining shareholder, we'll buy it back. And if we don't buy it back. And if we have the choice of buying businesses that we like or buying back stock, controlling factors how much money we have, we'd rather buy businesses. And so it isn't, you know, we don't stay awake at night working out formulas or anything of the sort. But we don't ever do it if we think that we're not doing something at the time. If we had a lemonade stand and Charlie and I and you owned it, and the lemonade stand was making us about $1 a week or something, and we divided it up, and you said you wanted to get out. And if you said one number, we'd have the funds in our little lemonade company, and we'd buy you out. And if we didn't like the price, we wouldn't buy you out. And it's the same way we feel. But we do feel an obligation to do things that we think are intelligent and in no way risk, absolutely no way present any risk of financial problems under any circumstances we can envision, except maybe something like nuclear war. You know, we'll do it, but it never can be that big a factor. Certain companies, well, Charlie, I think, spoke the other day in connection with Henry Singleton. I think he bought back 89% of the company over time, and he sold stock like crazy, or issued it much earlier when it was overpriced, and he bought it back underpriced. But the key to that, of course, is having people think you're wrong in doing it. So he was able to buy a ton of it. And there's some other companies that have bought a ton of it, and Berkshire isn't going to get the chance to do that because if people think we're buying, we've got sensible shareholders, is what it amounts to. If we had the same group of shareholders that own 2-day puts, and they were our shareholders, we'd buy back the whole company, you know, in a very short period of time. But it's such an easy concept to assess. I mean, the second stock I bought City Service Preferred. That was the first one. Second stock I bought was a company called Texas Pacific Land Trust. And that came out of the bankruptcy of the Texas and Pacific Railroad back in the 1880s or something like that. And they had 3 million some acres, and they owned the minerals, and they owned the surface and everything else. But it was terrible land in the 1880s. But they had some kind of a charter that said, use the proceeds from land sales, whatever it was they were going to buy in stock every year. And I sat there when I was 13 or 14, and I figured if I lived to be 100, I would own the whole place. Well, I haven't lived to be 100 yet, and I wouldn't have bought the whole place. So both calculations are so far imperfect, but it's been a remarkable company. Just plain remarkable, because they would talk about grazing fees of $6,000 a year or something like that, maybe when they had 3 million acres. And then they kept finding oil and more oil and more oil, and they've changed the form and all kinds of things, but they bought in stock week after week after week. And I sat there and figured out how long it would take until I owned the whole company. And I obviously made some improper calculations because it wouldn't have worked that way. But it still was apparent to me that it would be a very good idea if they had 3 million acres down there, that if they got all through with it and they kept their mineral rights and all kinds of things, which they were doing, it ought to, at a very cheap price, it ought to work out well for anybody who sat around for a long time. And it has worked out extremely well for anybody who sat around a long time, but nobody knew that they were going to find a lot of oil, and that eventually El Paso would grow out far enough so that the surface lands became worth some money, that they were somewhat near El Paso. Then you had to go a couple of hundred more miles to find the next person, but that was another problem. So it's just so, some of the stuff is so simple, but people want to get their PhD or something, so they work out hundreds of pages and have lots of Greek letters in it and all that sort of thing. And either you're buying out your partner at an attractive price, or you're not buying them out at an attractive price. And if you got the money around to do it and the price is attractive, you don't have some other opportunities, why not do it? You got to come out ahead by doing it. And if you've got other things that are more intelligent, you don't do it. And if it isn't intelligent on an absolute basis, you also don't do it. Charlie, have you got anything to add to that? What were you doing in 1943? You were in the service. And
Warren, we'd be crazy if we didn't rather enjoy having come a considerable distance from small beginnings. And to do that in good company, it's a favored life.
Yeah.
We've been very fortunate.
Yeah. And tomorrow, Monday, I can tell you it's almost certain that if anybody offers us, well, there'll be shares trade at Berkshire, and we won't buy any. But it's also a pretty fair chance someday a lot of shares, quite a few shares, not a lot. Berkshire's got our shareholders are too smart. That's one of our problems. If we want to repurchase shares. But we really don't want to squeeze it. We don't want to squeeze out anybody, but we also are here to do things that increase the value for the people who stick with us. I mean, it's not very complicated, and there'll be times when we'll do it, and there'll be times when we won't. But there won't be any formula, but there will be the principles that I've just expressed, and my guess is that my successor and their successor will have a similar calculation, because we're looking for people that are rational and devoted to Berkshire. So, Glenn, thanks for coming. And Becky, you're next.
This question was sent in by Dave Shane from Brooklyn, New York. He's responding to something he heard earlier today. He said, in the future, will Greg be able to act with the same spontaneity that you mentioned earlier and make immediate multi-billion-dollar decisions without board approval?
Well, my guess is that the board, it's just, they respond as people do. They'll put some more restrictions, or they'll have some more consultation on a lot of matters or some matters, than they do with me. I mean, they won't need to, but they'll feel that they haven't had the experience, they haven't seen them as long, and then a whole bunch of things, and they'll feel that the Delaware laws protects them better. And incidentally, they don't have directors and officers liability insurance. I mean, virtually every company on the New York Stock Exchange has it, and we just don't buy it. I mean, come on the board and you're a trustee for a whole bunch of people that trust you and me. I'm talking about the directors and me. Fine, but it's very interesting. People go on museum boards, and they're expected to contribute. People go on college boards, and they're expected to contribute money. And they say it's a great honor to be on a university board or a museum board or whatever. It's a great honor, and therefore you should raise money for us. Well, frankly, I think our board's more interesting than being on a university board or a hospital board or something. I wouldn't know what they were talking about anyway, and on museum board or art board. So, but people have found that they can make $300,000 a year, which is way more, which is enormously important to some people and is meaningless to others. And I mean, the chances are, if somehow they'd arranged it so that directors didn't get paid at all, there'd be plenty of people who wanted to be directors, and it'd be a prestigious sort of thing and all that. But in effect, it's money that comes very easily. The whole idea of the independent director, frankly, it just doesn't really make any sense.
You don't think a director is independent who needs $300,000?
He needs the money. Yeah, I mean,
he's independent the way a slave is independent.
I am going to read a few sentences which are absolutely the case. Except I'm doctoring. There's just I don't want anybody to be identified, obviously, with this. And these are word for word excerpts. I'm not telling you whether it's a woman or a man. I'm going to use a male pronoun because it's easier. But I picked out a few sentences from a letter I received many years ago. And this letter said, "I'm writing to you with a great deal of reluctance and a sense of personal embarrassment. I have tried all of the conventional means of raising the money." This person needed a couple $1 million. And I wouldn't have known the person if I saw him on the street. But it wrote this letter and said, "I need a couple $1 million. And then this is the item that I think you might find interesting. And I've kept the letter. "My income is composed 100% of my board fees." Well, I just looked him up, and at the time, he was a director of 5 prestigious companies, and had been directors of others, and he's going to be director of a whole bunch of things. But he was desperate for money, and he says he's getting 100% of it for board fees. And he was an independent director, classified as an independent director at every one of these companies. It's just astounding to me that we're going to have a shareholders meeting in just a couple of minutes. We're going to start it, and it's just astounding to me that in 2006 we own 9% of the Coca-Cola company. I mean, maybe they gave me a free Coke. I mean, but we own 9% at Berkshire Hathaway. We obviously cared about the future of the Coca-Cola company, and just so happened in that year, CalPERS and a few others recommended that we be voted against for something or other, and at one time there were 2 big institutional investors, voted because they didn't think I was independent, because Dairy Queen bought some Coca-Cola, or actually the people that had our franchises bought some Coca-Cola. I mean, do they think I can't add things? And if we've got billions and billions and billions of dollars, that I'm going to be compromised? But it's just nutty. And so one year, my vote fell from 96%, yeah, maybe it was 98% vote approval, to 84%, because I forget whether it's 2004 or 2000, somewhere along the line, they just decided that I wasn't the right sort of person to be able to handle these responsibilities. And the idea that somebody, it's an important part of their income, I mean, what they want, they may want to do a lot of other good things. It doesn't mean they're terrible people. But if the difference is whether you, how you live, and in this case, whether the person would go broke, how in the world you can call somebody like that independent and say that anybody owns a lot of, maybe Walter Scott's, not independent, or maybe, it's just ridiculous. But it's the way the rules are, and we follow the rules. But
Warren, they don't want them just independent now. They want one horse, one rabbit, one cow, one whatever.
Yeah, I mean, I feel like Galileo.
Independence is not enough. You got to have a very diverse kind of independence.
Yeah, and if you desperately need the money, in this case, 100% of the income coming from it, you're on 5 of the most prestigious boards in the country, and classify as independent on each and other, and all you're hoping is that your CEO gets called by another CEO and says, "Is this guy okay?" And you say, "Of course he's okay," which means, of course, he doesn't cause trouble, and so he gets on a 6th board. Anyway,
I know. All I say is it's not our idea of an independent director.
No, it's all a little crazy, which brings us to the fact that we're now going to have our annual meeting here. In about 15 minutes, we'll reconvene at 3:45, and then we'll do the business of the meeting that is required. And you're all welcome to stay, it's very... We're now come to the moment you've all been waiting for. We will have the annual meeting. Charlie doesn't join me for this because once or twice in the past he was caught on camera sleeping. So we've solved that one. And we're now going to have an annual meeting where I follow a script. And you may think that's impossible, but I'll do it. So the meeting will now come to order. I'm Warren Buffett, Chairman of the Board of Directors of the company. I welcome you to this 2022 annual meeting of shareholders. Mark Hamburg is Secretary of Berkshire Hathaway, and he will make a written record of the proceedings. Rebecca Amick has been appointed Inspector of Elections at this meeting, and she will certify the count of votes cast in the election for directors and the motions to be voted upon at this meeting. The named proxy holders for this meeting are Greg Abel and Mark Hamburg. Does the Secretary have a report of the number of Berkshire shares outstanding, entitled to vote, and represented at the meeting?
Yes, I do. As indicated in the proxy statement that accompanied the notice of this meeting that was sent to all shareholders of record on March 2nd, 2022, the record date for this meeting, there were 614,692 shares of Class A Berkshire Hathaway common stock outstanding, with each share entitled to 1 vote on motions considered at this meeting, and 1,287,633,719 shares of Class B Berkshire Hathaway common stock outstanding, with each share entitled to 1/10,000th of one vote on motions considered at this meeting. Of that number, 423,719 Class A shares and 759,159,354 Class B shares are represented at this meeting by proxies returned through Thursday evening, April 28th.
Okay, and I will interrupt this meeting for 1 second to announce that we're still selling things next door, and we've sold 15 boats. So, with that brief commercial, and if anybody leaves, I will not be offended. Thank you. The number represents a quorum, and we will therefore directly proceed with the meeting. The first order of business will be a reading of the minutes of the last meeting of shareholders. I recognize Ms. Sudecker, who will place a motion before the meeting.
I move that the reading of the minutes from the last meeting of shareholders be dispensed with and the minutes be approved.
Do I hear a second?
I second the motion.
The motion is carried. The next item of business is to elect directors. If a shareholder is present who did not send in a proxy or wishes to withdraw a proxy previously sent in, you may vote in person on the election of directors and other matters to be considered at this meeting. Please identify yourself to one of the meeting officials in the aisle so that you can receive a ballot. I recognize Ms. Sudecker to place a motion before the meeting with respect to election directors.
I move that Warren Buffett, Charles Munger, Gregory Abel, Howard Buffett, Susan Buffett, Stephen Burke, Kenneth Chenault, Christopher Davis, Susan Decker, David Gottesman, Charlotte Guyman, Ajit Jain, Ronald Olson, Wallace Weitz, and Merrill Whitner be elected as directors.
I second the motion.
It has been moved and seconded that the 15 individuals named in Ms. Decker's motion be elected as directors. The nominations are ready to be acted upon. If there are any shareholders voting in person, they should now mark their ballot on the motion. Ms. Amick, when you are ready, you may give your report.
My report is ready. The ballot of the proxy holders in response to proxies that were received through last Thursday evening cast not less than 449,190 votes for each nominee. That number exceeds a majority of the number of the total votes of all Class A and Class B shares outstanding. The certification required by Delaware law of the precise count of the votes will be given to the Secretary to place with the minutes of this meeting.
Thank you, Ms. Amick. The 15 nominees have been elected as directors. The next 4 items of business relate to 4 shareholder proposals that are each set forth in the proxy statement that can be accessed at berkshirehathaway.com. The first proposal requests that the company adopt a policy and amend the bylaws to require the chair of the board of directors to be an independent member of the board. The directors have recommended that the shareholders vote against the proposal. I will now recognize Peter Flaherty, a representative of National Legal and Policy Center, to present the proposal.
Good afternoon. I am Peter Flaherty, chairman of the National Legal and Policy Center. I'm from Washington, D.C., but please don't hold that against me. Our proposal would separate the roles of chairman and CEO. Sorry, Charlie. But I would take it one step further and suggest that Berkshire remove itself from corporate America's assault on American institutions and culture. I'm proud to say I'm a capitalist, but it is obvious to me that capitalism is failing to deliver for the American people. Real wages have been falling for years. Wealth disparity has never been greater. And right outside my hotel window here in Omaha is a homeless encampment, an all too familiar sight in American cities. We don't have a free economy, we have bailout capitalism. When small businesses lose money, they go out of business. But when billionaires bet wrong, government steps in. Money printing by the Federal Reserve and irresponsible, debt-fueled spending by politicians, what they call fiscal stimulus, have artificially inflated asset values. So those with the most assets benefit the most. Wage earners get ruinous inflation. But even worse than the wealth gap is the values gap. The top 1% now seek to impose their corrupt morality upon the rest of us, whether it's in the form of critical race theory, transgenderism, or the myriad of other woke causes that permeate corporate advertising and messaging. Why has corporate America embraced both economic and cultural radicalism? It's pretty simple. When you have so much money, your fortune is going to come under scrutiny. The best way to insulate yourself and keep anti-business off your back is to embrace their causes, even if in the process you undermine the system that produces your wealth. That is what allowed Mr. Buffett to advocate for higher taxes, even though they will fall in the middle class. The Federal Reserve has offered free money to corporate America for over a decade now, creating a class of oligarchs and greatly enhancing corporate political power. Executives now believe that they can tell elected governors and legislators what to do, as we've seen in Indiana, Georgia, Texas, and Florida. Last year, Coca-Cola CEO James Quincy, a British citizen, sought to kill Georgia's new voter integrity law by making inaccurate and inflammatory statements about it. He also instituted diversity training, whereby white employees were encouraged to try to be less white. Despite being Coke's most celebrated shareholder, Warren Buffett is nothing about Quincy. In fact, Mr. Buffett jumped on the America is racist bandwagon by signing a statement by corporate leaders suggesting that Republicans seek to restrict ballot access based on race. All this did not prevent Coke from sponsoring the Winter Olympics in China, which has never had a free election, and where minority communities are the victims of genocidal policies. And what about Apple? A large part of Apple's supply chain is in China. The company removes apps from the App Store at the request of the Chinese government because they are used by human rights activists. And of course, Apple is the world's most successful corporate tax minimizer, famous for routing profits through offshore tax shelters. Over at American Express, the company instituted an anti-racist initiative for employees that teaches that capitalism is fundamentally racist and requires workers to engage in an exercise to determine whether they are the oppressor or the oppressed. Activism by woke CEOs may be reaching its limits. The people of Florida are fighting back against Disney's Robert Chapek, who not only embraces the view that gender is a form of oppression, but that kindergartens must be forced to confront it. Mr. Buffett has praised the brand endurance of Disney's characters and the trust parents place in its content to be safe and appropriate for children. But now the company is adding warnings to Dumbo, Peter Pan, and Aladdin about the stereotypes they allegedly portray. And poor Prince Charming has been excised for kissing Snow White, quote, unquote, without consent. Warren Buffett has yet to address the crisis dripping corporate America, and I fear he never will. Yes, Berkshire may be a holding company, and Mr. Buffett may stay out of the way of managers. But what happens when these executives use their companies to wage a social revolution that most Americans don't want? Is he not responsible? He can't have it both ways. In this country, wealth has been admired and even celebrated because our system allows anyone to become rich. But what happens when Americans suddenly find their history and future under attack by corporate America? The social compact that permits such affluence will be broken. Mr. Buffett, if you are the face of the capitalism, why don't you do something to save it? Thank you.
Okay. Thank you, Mr. Flaherty. Well, if there are any shareholders voting in person, they should mark their ballot on the motion. Ms. Amick, when you're ready, you may give your report.
My report is ready. The ballot of the proxy holders in response to proxies that were received through last Thursday evening cast 72,298 votes for the motion and 421,181 votes against the motion. As As the number of votes against the motion exceeds a majority of the number of votes of all Class A and Class B shares properly cast on the matter, the motion has failed. The certification required by Delaware law of the precise count of the votes given to the Secretary to be placed with the minutes of this meeting.
Thank you, Ms. Amick. The proposal fails. The second proposal requests that the company publish an annual assessment addressing how the company manages physical and transitional climate-related risks and opportunities. Directors have recommended that the shareholders vote against the proposal. I will now recognize Tim Humans, a representative of Federated Hermes, to present the proposal.
I thank the chair, the board, and fellow shareholders. I'm Tim Yeomans, lead North America, EOS at Federated Hermes, here today to talk about ballot item 3, a proposal that is co-sponsored by Brunel Pension Partnership Limited, represented by EOS, Caisse de dépôt et placement du Québec, California Public Employees Retirement System, and State of New Jersey Common Pension Fund D on behalf of their combined millions of ultimate beneficiaries. EOS, CalPERS, and CDPQ co-sponsored a similar proposal last year, asking the company to commence climate-related risk reporting, which the company has not started. The context for this year's parent company climate reporting proposal is, however, different in 3 ways. First, we've added New Jersey Common Pension Fund D. Second, we stand before this annual meeting of shareholders backed by, in our estimate, the majority of non-insider votes cast at last year's annual meeting. We provided the company tallies showing that the majority of non-insider votes cast supported last year's proposal, and Glass Lewis has also corroborated this result. The company disagrees, but has not shared its reasoning. Third, the parent company began engaging with the co-sponsors this year, and the company recently published a supplement to the chair's letter from Vice Chair Abel discussing climate change matters in the company's energy and rail subsidiaries. Also, the parent company's audit committee has amended its charter to now include climate risk oversight. We welcome the company's new engagement approach, Vice Chair Abel's supplement, and the revised audit committee charter. However, these changes do not address in any meaningful way what last year's non-insider majority-supported shareholder proposal asked for, and what this year's ballot item 3 asked for, which is that the parent company should, A, commence annual climate-related financial reporting for its subsidiaries where material, and for the parent company as a whole following the recommendations of the task force on climate-related financial disclosures. B, explain how the board oversees climate-related risks for the combined enterprise. And C, explore the feasibility of the parent company and its subsidiaries establishing science-based greenhouse gas reduction targets. Here is why all shareholders, including the non-insider shareholders who supported last year's shareholder proposal, should once again this year tell the board to change course and support parent company climate risk reporting. Vice Chair Abel's supplement talks about emissions reductions. We ask the parent company to report on climate-related financial risks, not just emissions reductions, as these risks may be material. Abel's letter also talks about emissions reductions in rail and energy, 2 of the 4 giants of Berkshire Hathaway, as they are referred to in the chair's annual letter. What about climate risk in insurance? The company has 60 subsidiaries and more than a few large investment holdings. The company should disclose material climate-related financial risks beyond rail and energy in a composite parent company picture. We asked the company to allocate a small portion of its more than $100 billion in cash equivalents to climate risk reporting at the parent company level. Climate financial risk may be significant, even material at the parent company. On page K26 of the 2021 annual report, the company states that climate-related risks could produce losses and significantly affect financial results. The company audit, however, is silent on climate risk. We have asked the auditor, Deloitte, to explain this inconsistency. We asked the Audit Committee to explain why Deloitte has not disclosed how it considered climate-related risks in its review of financial statements, when the company itself disclosed this is a significant risk. Investors representing $68 trillion in assets make up the Climate Action 100+ collaborative engagement on climate change. Berkshire Hathaway is the only major public company in the U.S., the only one, to earn now for 2 years in a row a score of 0 on the CA 100+ net zero assessment of climate progress. The undisputed worst performer. This stands in stark contrast to Berkshire Hathaway's track record of usually strong long-term financial performance. In response to last year's non-insider majority shareholder vote, the company has made a start towards climate action. Much more is needed. Vice Chair Abel is the named CEO's successor. His annual meeting remarks, both in 2020 and last year, and his recent letter show he has a solid grasp of climate risk. We ask Vice Chair Abel to commence climate risk reporting at the parent company level. This would give the company a head start in complying with the SEC's new proposed climate disclosure rules that ask for more disclosure than we asked for in item 3. We ask all shareholders, both non-insiders and insiders, including the chair, to cast their votes for item 3 in support of parent company climate risk disclosures starting before the 2023 annual meeting. Thank you.
Thank you. I do think it's worth discussing just a little bit who the actual constituency is of public pension plans. Generally speaking, we hear from various pension plans, and it's not limited to California in the least, but saying, they're protecting the holders of the pensions, and the retired people and all of that, and therefore they're usually suggesting that something that we may or may not agree with in terms of whether it's actually in the economic interest, but they do, and they honestly feel, incidentally, that they are representing the pension holders. People are going to get these checks every month now. They're getting them now. They may get them later. It's a very understandable position. But of course, in essence, that's not who they represent. The people that are promised the pensions, whether it's in California or any other state in the union, they're going to get their checks. It's obvious. The United States, American people of California are simply not going to stand for the fact that people don't get their checks. So one way or another, they're going to get their checks. And to the extent possible, the states will attempt to realize from the taxpayers of the state in the future enough money so they can pay the checks. I mean, that's why states have adopted pension plans and that sort of thing. And many of the states have found their taxes to go up. I mean, in effect, no state government, public opinion in the United States, they're not going to allow people not to get their pension checks. And the state does have the right to tax income and property and various things of people within their state. And they'll exercise the power, or they'll look to the federal government for grants, or they'll do anything. But the one thing they aren't going to do is stiff the pensioners. So you're probably representing, if you're on a public pension board, you essentially are representing the future taxpayers of the state. Now, there's one problem about future taxpayers. They can leave the state. And it gets awkward in certain states, particularly when people start leaving the state, because the revenue that goes with those people from income taxes and sales tax and so on. So people have a fair amount of freedom of movement. They don't feel the same way about U.S. taxes. Not very many people are going to move from one place to another, but they may even be, in the United States, they move. And it's gradual. Sometimes it isn't so gradual. And of course, as the tax base goes down, the past pensions stay. So they become kind of like an aging steel company or something of the sort, that whatever it may be, where the pension plans may become insolvent, but they're going to keep paying the people, just like we're paying on, we've adopted certain policies on multi-employer pension plans and so on in the country. The United States is not going to stiff a bunch of people, particularly people that vote, but the moral feeling is to do it. So the people that the trustees should be worried about, because they, of course, is the future taxpayers. And if they really mess things up, those taxpayers become more and more likely to leave, and it has a lot of effects. Interestingly enough, one of the calculations that might go on in Berkshire's mind, if we're going to build a plant someplace that's going to sit there for 50 years, is whether there are going to be any people around that are going to pay the tax and we can't move our plant. So all these invisible decisions go on all the time. And I don't think there's anything wrong with representing the taxpayers of the future. I don't think there's anything wrong with sitting on a pension board, but I do think they ought to actually figure out who really is, they really are representing, and they're representing future taxpayers. And in some cases, they're creating some tremendous problems for future taxpayers, because like politicians, they've got promises they're going to fulfill, but they've got to do it from revenue that comes in the future, and they can't print money, and people can leave their state. So it's an interesting set of problems. And I can't resist mentioning, in 1991, you've seen that Solomon tape, when Solomon was essentially might or might not have gone down the drain and had a bankruptcy, which was, in my opinion, would have spread like wildfire. And who knows what would have happened, just like in 2008 and 9, when Lehman fell and a few things. I mean, who knows what's going to happen after something like that. So Solomon was bigger relatively by far than Lehman was in 2008 and 9. And on a Sunday in August, the Treasury Department, the Securities and Exchange Commission, the Federal Reserve, all decided on a Sunday that something they did on Sunday morning really was a mistake, and that they better change it on a Sunday, or the whole economic system might go down the tubes. And in this book, which we have for sale out here, the other $1 Trillion Triage, in the first early page, it describes that period. I didn't know some of the stuff that's in the book even that was going on, but essentially, the Federal Reserve, Alan Greenspan was brought in one time, Jerry Corrigan was there, Nick Brady was Secretary of the Treasury. They decided, with various degrees of conviction, but they did decide, because they had to decide by roughly 2:30 in the afternoon whether something they did at 10 o'clock, which was kind of unprecedented, they were going to reverse themselves. Now, can you imagine trying to get institutions like the Federal Reserve and the Treasury Department to reverse themselves? But they did realize that they had probably done something that was going to cause a huge bankruptcy, which could turn into a whirlwind in Wall Street. So they reversed themselves, and tells the story in this $1 Trillion Triage. And I knew some of what was going on. There was other parts I didn't know what was going on. Anyway, all of those institutions reversed themselves very reluctantly. Big institutions do not like to reverse themselves, and particularly not 4 hours later. And when some guy from Omaha said, if they do this, we're going to declare bankruptcy in Tokyo because we're going to have a multi-billion-dollar run and we can't pay it. And directors who approve preferential payments when they know the place is going bust have all kinds of legal liability, and the whole thing was falling apart. And to their credit, enormous credit, you basically had the Fed and the SEC, mostly it was the Fed and the Treasury, and they said, we just can't have this happen. It could produce a national catastrophe. And for some weeks, we had about 130 or 40 billion dollars of funding, and 130 or 40 billion dollars was a lot of money in those days. We were one of the 3 or 4 largest borrowers in the United States, and we borrowed daily, and we borrowed against government bonds. We had inventory there, but we only had $4 billion of equity, and we had 130 billion. And there was a guy, a wonderful guy, John McFarland. He was the treasurer. He slept down at the downtown offices, or right near their offices of Solomon, for days and days and days and days because $1 billion a day was draining out. There was a run on Solomon, and it was a run that the Treasury and the Fed and the SEC did not want to have happen, and it reversed themselves and everything. And a few days into it, for whatever reason, but CalPERS was a big lender to us, and they decided they weren't going to do business with Solomon anymore. So they were going to precipitate they were going to accelerate the run on. And they announced one day that they kind of approved of everything that was going on, but they just didn't want anything to do with us, even though we were giving them government bonds as security. And this was accentuating the problems for the Federal Reserve, the U.S. Treasury, and the SEC, and no one knew how it was going to come out. But they pulled, and other people pulled, and John McFarland stayed downtown and kept trying to raise $1 billion every day to pay off people in terms of run that was occurring. And the Fed did not want this run to get out of hand, but they couldn't give us the money. And the Treasury didn't want the run to get out of hand, but they couldn't give us money, and so on. And it was, it was a terrible problem. And CalPERS, like I say, they said, well, we don't want anything to do with these guys, so we won't lend on government securities, even though the loan is good. And then a little later, they sent word to me that if I would come out to California and talk to the people, the trustees, that then they would reconsider. So that was what they wanted as part of their deal, not to keep participating in this run and take a different position. And I never would have done this for anything except for the fact that it was Solomon. I mean, so basically I got on a plane and I flew to California and I met with the CalPERS people, and I wasn't charging them anything. If I'd been charging them a lot of money, they would have paid attention, and they still paid attention. They were very nice to me when I went out there. And I talked to them, and they were happy, and they clapped, and they didn't pay any attention to what I said because I wasn't charging them a big fee or anything of the sort. And I went back to New York, and then they started doing business with us and announced that really they had decided Solomon was fit to do business. So I have a little bias in terms of when they come around and they present a proposal, and they say that in their proposal, and this is in our proxy statement, and we filed this with the SEC. We're not going to say it if it isn't true. And basically, they make a mistake. They and some other people that do this, they make a mistake and say something about the shareholders voting. It says the 2021 annual meeting, this is part of their supporting proposal, where a significant majority of non-inside shareholders supported a similar version of this resolution. Well, we say in our response the proponent's assertion that at the 2021 annual meeting, a significant majority of non-inside shareholders supported a similar resolution is incorrect. And in fact, a significant majority of such shareholders did not support the proposal. That's either true or false. And I have the last report submitted by that same firm that handles our material at Broadmoor, what is it, Broadbridge. And it reports the number of shareholders. It's the last day before the voting or something like that. And it's got the number of shareholders that support us and are against us, and it's 4-1 in our favor and something like that. And it just doesn't make any difference to them. I mean, it's fascinating to me that and I would be willing to wager somebody if we could find an impartial judge that if you go to any group you want to pick, take the CEOs of the 5 leading utility companies in the United States, the CEOs of the 10 league, and ask them, whether Berkshire Hathaway Energy has been a leader in the field of renewables and so on, and they'd all say yes, but essentially you've got a group of people that write us letters and say we want you to do things our way, and you've got 3 million other shareholders, but forget about them and spend some money on this and have a meeting with us, and here's our way of measuring it. And admittedly, we've got all kinds of information up about what we've done, and they can come out to Iowa and look around, and it is the renewables capital of the world practically, and we're the ones that have done it. And that isn't what they want. So I'm for shareholder democracy and all that sort of thing, but the answer is that the resolution, they pay lots of money to somebody that probably works in these groups, and they've got groups of they've got their way of doing. I get letters from institutions in Europe, and they say, well, you may have 40 pages or a history going back to 2006 of explaining what you're doing, but here's the way we want you to do it. And how much energy is Garanimals, which we own, is it's just you have to think, as a person sitting here, and it's nutty, but these are the rules. You get on the proxy statement under certain circumstances. Most companies, they don't want a lot of resolutions, so it's just easier for them to, set up a department and, pay a bunch of people to pay attention to him, just like Warren did when he flew across the whole country, because it wasn't money. I was worried about a company surviving that the people in Washington, the supervisor, were worried about it surviving, and if I flew across country and paid them sufficient respect, I mean, it was kind of like The Godfather or something. I just bowed out and then flew back. So I have a certain reservation about shareholder proposals should have some meaning. I mean, it's the kind of thing I argued for when I was younger, but basically it's become, in my opinion, there's certain items that you can put on the ballot and certain that you can't. And practically every executive in the country now, the chief executive, wants to have a virtual meeting. The last thing he wants to have shareholders and people stand up and propose things. And we'll just keep talking about it the way we see it is. And in the end, we will have a report as to the vote, and this time, and I can assure you, we're not stuffing the ballot box. We're not doing anything. I mean, voter fraud. It's not like Chicago in the old days where you waited for the cemetery vote to come in and that sort of thing. We don't count the votes. We don't say where they come from. We don't know where they come from, but we can tell when 2 or 3 institutions that got huge amounts of shares, but they're one owner, and they vote a certain way, and then they feel pure, and they don't really, what they care about is whether we check their boxes and the people that work for them. A certain number of people are getting employed by them, and their hearts are pure, but ours aren't impure. And with that, I think we ought to, well, I won't do this again, but it's a really interesting development in terms of getting more a rules-based type of situation where basically no company, almost every company, figures out how to negotiate with the people, and they all have a good many of the CEOs. I mean, they just figure it's something that they endure in the business, and they set up a department to answer the questions and meet with the people and show the proper respect and so on. And it's being done to carry through on something which I think the substance of is pretty similar. If I thought Berkshire Hathaway Energy was behaving in a way that was bad for society, worse than other utility companies, but no company. And the reason, of course, is that we don't take dividends out of it. So we pump tens of billions of dollars into the business. Most, practically every utility pays out the dividends. And it's not the fault of the utility management. That's just a policy that's been the case in the utility industry. But they don't really have much cash left over. And we have plenty of cash, and we'll put in more cash, and we're willing to build, whatever amount of transmission lines and all kinds of things that would be helpful to the country. And we're doing a fair amount of it, but we could do a whole lot more. And we're better positioned to do it, really, than any utility company in the country. And I think if you talk to other utility executives, I don't advise you to go and put them on the spot or anything, but they would agree. But they also know that their life is easier if they just have somebody to take care of people that want to be catered to, basically. And I catered to them in the time of Solomon in 1991 because 8,000 people were working there, and John McFarland was trying to raise $1 billion a day in the Treasury and the Fed, and the SEC wanted us to stay alive. And in effect, that caused me to go and pay my respects to the Godfather, and I came back. But I do think a little background is kind of interesting on this. And with that, we'll ask Ms. Amick, can you give your report?
My report is ready. The ballot of the proxy holders in response to proxies that were received through last Thursday evening cast 127,214 votes for the motion and 370,415 votes against the motion. As the number of votes against the motion exceeds a majority of the number of votes of all Class A and Class B shares properly cast on the matter, the motion has failed. The certification required by Delaware law of the precise count of the votes given to the Secretary to be placed with the minutes of this meeting.
Yeah, and I will just add that, I got a report a day or two ago, the last report they sent me from this firm, and it's 4 to 1 or 5 to 1. I'd be glad to share it with anybody. But anyway, in terms of number of shareholders, that based on what these people in New Jersey told me the vote was, we're against it. And and if they would reintroduce the proposal next year, I just hope they leave that line out, because I would just suggest that somebody read what the proposal is or what the facts are before they announce their proposals and all that sort of thing. Okay, well, the third proposal requests that the company issue a report addressing if and how it intends to measure and disclose and reduce GHG emissions associated with its underwriting, insuring, and investing activities. The directors will recommend that the shareholders vote against the proposal. I will now recognize Jalen Spann, representative of Whistle Stop Capital, to present the proposal.
Chairman, Mr. Buffett, and board members, good afternoon. My name is Jalen Spann, and I want to first thank you for the opportunity to present proposal number 4 on behalf of shareholder representative As You Sow. This proposal asks Berkshire to measure, disclose, and begin reducing the greenhouse gas emissions supported by its insuring, underwriting, and investment activities. In its most simple terms, the proposal asks Berkshire to take responsibility for its contribution to climate change. The U.S. Commodity Futures Trading Commission has acknowledged that climate change can impair the productive capacity of the national economy. The litany of national and global events associated with climate change, the fires in California and Colorado, the floods across the Midwest, the growing strength of hurricanes, the deep freeze in Texas, to name just a few, demonstrate the growing risk and costs of climate change. 2021 was the second most costly year on record for the world's insurers, with insured losses totaling $120 billion from natural catastrophes. Significantly, these losses can no longer be categorized as simply a bad year. As noted by Munich Re, economic losses caused by natural catastrophes are trending upward. The insurance industry faces year-on-year growth in insured losses related to climate change. Berkshire is not only exposed to climate-related risks, but it is actively amplifying these risks through its continued investment in and underwriting of high-carbon activities. Berkshire is one of the largest providers of coverage to the oil and gas industry, surpassing peers such as Chubb and Liberty Mutual. Its shareholdings in coal alone amounts to $5.1 billion, once again, far surpassing its American peers. A financial institution's investment and underwriting activities are by far the greatest source of its total carbon footprint, highlighting the need for Berkshire to measure, disclose, and begin taking responsibility for the emissions it enables. The global financial sector is rising to the challenge of meeting the Paris Agreement's goal to maintain global temperature rise at 1.5 degrees Celsius. The Net Zero Insurance Alliance has grown to 22 members, 7 of which are in the top 30 largest global insurers by market cap. All members have committed to reach net zero emissions from their insurance and reinsurance underwriting portfolios by 2050. AIG and The Hartford have also recently committed to reach net zero emissions from their underwriting and investment portfolios by 2050 or sooner. Berkshire is lagging both its American and its European peers, a position that increases climate risk globally and to its own portfolios. The insurance industry, and Berkshire specifically, has a key role to play in the ongoing low-carbon transition. And we believe Berkshire has the ability to become a climate leader on this critical issue. And the first steps are to quantify the emissions associated with its underwriting and investing activities, disclose those emissions, and begin developing plans to reduce those emissions in alignment with the Paris goal. To ensure global success in protecting this planet and its inhabitants, every business must take responsibility for its own contribution to climate change. And we look forward to working with Berkshire to address this vital issue. Thank you.
Thank you, Ms. Bunn. The motion is now ready to be acted upon. If there are any shareholders voting in person, they should now, how about a little light up here? They should now mark their proposal, their ballot on the motion. Ms. Amick, when you are ready, you may give your report.
My report is ready. The ballot of the proxy holders in response to proxies that were received through last Thursday evening cast 127,065 votes for the motion and 370,630 votes against the motion. As the number of votes against the motion exceeds a majority of the number of the votes of all Class A and Class B shares properly cast on the matter, the motion has failed. The certification required by the Delaware law of the precise count of the votes given to the Secretary to be placed with the minutes of this meeting.
Thank you, Ms. Amick. Proposal fails. The fourth proposal requests that the company report to shareholders on the outcome of its diversity, equity, and inclusion efforts. The directors have recommended that the shareholders vote against the proposal. I will now recognize Jalen Spann, representative of Whistle Stop, to present the proposal.
Hello, I'm Jalen Spann. I'm speaking on behalf of the nonprofit advocacy organization As You Sow and Whistle Stop Capital. I formally move proposal number 5, asking for Berkshire Hathaway to report on the outcomes of their diversity, equity, and inclusion efforts by publishing quantitative data on their workforce composition and recruitment, retention, and promotion rates of employees by gender, race, and ethnicity. Warren Buffett once mentioned that he had grown up with 2 sisters who, to quote Mr. Buffett, are absolutely smart as I am and better personalities. He also bravely admitted that he only placed women on his board after his wife suggested it in 2003. 40 years after he started his company. It's one thing to know that people of all genders, races, and ethnicities can contribute to Berkshire Hathaway. It is another thing entirely to intentionally and proactively create the space, opportunity, and training needed within a company for those people to be able to contribute without facing harassment and discrimination. In the absence of data, we must instead assume that Berkshire Hathaway companies are no better nor any worse than any company in America. The statistics for American companies are unacceptable, particularly when we consider the strong link found by the Wall Street Journal, McKinsey, Credit Suisse, and others between diversity, equity, and inclusion programs and corporate outperformance. 42% of Americans have witnessed or experienced racism at work. 64% of Black employees say that discrimination is an issue in their own workplace. Many people of color are barred from entering the workplace at all. A meta-study reviewing data from 1989 to 2017 found that, on average, whites receive 24% more callbacks than Blacks and 36% more callbacks than Latinos. If we take a look at Berkshire's executive team, we can see that headquarters should be proud of the gender and racial diversity present in its leadership team. The culture that exists at Berkshire Hathaway headquarters appears to be one that recruits, hires, promotes, and retains diverse employees. Mr. Buffett stresses the importance of culture and the value that it has on the long-term success of a company. He said that culture, more than rule books, determines how an organization behaves. Investors are looking for assurances that this culture is successfully implemented within the famously decentralized Berkshire Hathaway companies as well. In order to allow their investors to understand their workplace diversity, 87 of the S&P 100 companies have released or have committed to releasing their EEO-1 form, which is a standardized government-mandated accounting of gender, race, and ethnicity breakdown by employment levels. By contrast, of the more than 60 companies Berkshire owns, only one has publicly released this form. One company. This is not the leadership that Mr. Buffett is known for. The company's inclusion data, the hiring, retention, and promotion rates of diverse employees must also be shared for investors to have a full understanding of the actual experience of not only Berkshire's employees, but of its portfolio companies' employees as well. The board has released insufficient information to assure investors that it is attentive to diversity, equity, and inclusion at Berkshire Hathaway companies. We encourage transparency, even in the face of imperfection, in order to show that the company's leaders are truly committed to change and to attracting, retaining, and promoting the best possible employees. Thank you.
I certainly agree with you that my sisters were better looking, smarter, had better personalities, and in 1930, they had a father and mother, teachers who loved them like they loved me. And if I'd been born female, black, in various other countries, I would not have had remotely the life I've enjoyed. But if what the people at the top believe is important in terms of how our subsidiaries behave, there's everybody that runs any one of our subsidiaries knows how I feel, and they also know that they're in charge of their own business. And that we think we've got great leaders in virtually every company we have. Every now and then we find we've made a mistake, obviously. But if the idea that I should replace any of the people that run the businesses, they're doing it. I just don't think that's the way to operate. And I will tell you, just so that the question doesn't come up later, in terms of our shareholders, by, again, a 4 or 5 to 1 vote, so the owners of the Berkshire company, whether not forgetting about A or B shares, basically the big funds that are worried about what their perception is, but also may well believe it. Who knows what people's motivations are? Somebody said that the word motivation should never be used in the singular because you really don't know. But the one thing is that it's very hard to find people that are running big institutions that are acting against their self-interest. Now, it doesn't mean they're acting for their self-interest necessarily. They're acting for a lot of reasons. But it's something that if you could change that in people, it would do a lot more for Americans in the future. But you basically can't change that. I mean, it's a situation of how people behave in protecting essentially their own interests and their own interests 40 or 50 years ago was essentially to regard corporate America as a boys' club, and that's not acceptable anymore, so they changed, but they haven't changed as much by a substantial margin in relation to blacks. And that's where we are as a society. But overwhelmingly, our shareholders don't agree with you, even though they had a chance to. You gave them a chance to express their view on it. So, Ms. Amick, when you're ready, you may give your report.
My report is ready. The ballot of the proxy holders in response to proxies that were received through last Thursday evening cast 123,614 votes for the motion and 373,925 votes against the motion. As the number of votes against the motion exceeds a majority of the number of votes of all Class A and Class B shares properly cast on the matter, the motion has failed. The certification required by Delaware law of the precise count of the votes given to the Secretary to be placed with the minutes of this meeting.
Thank you, Ms. Amick. Proposal fails.
I move that this meeting be adjourned.
I second the motion to adjourn.
Motion to adjourn has been made and seconded. The meeting is adjourned. Thank you all for coming.